Technology, the only daily business show dedicated.
He'll be talking about Europe soon. Roche is also in focus. The drug maker shares could be a little bit lower today on the back of some lung cancer news out of that company. The Compass Group catering company, their numbers not looking so bad, but the guidance and a lack of a buyback, according to Morgan Stanley, could weigh on the shares, Guy.
Let's take a look. Here we go. See how some of those single stocks will affect the market open, or does the macro top-down Trump trade exert a greater influence? We are expecting negative numbers to be posted straight out of the gate. The FTSE 100 is down, not by much. We're expecting maybe 0.3% lower for the FTSE 100. Do we see bigger numbers being posted elsewhere to countries that maybe could see greater exposure to that Trump trade? At the moment, that doesn't seem to be the narrative. Maybe the FTSE does fall in line with the wider European story. Does that allow us to question whether this is tariffs or whether it's simply something else? So here we go. The FTSE is down by 0.2%. The Stock 600 is down by now 0.4% as the CAC 40 opens down 0.8%. The IBEX is down by 0.8%. But maybe that does take us back to the idea that maybe the FTSE 100 is less exposed. We'll see how the DAX opens in just a moment, but we're still scratching our heads. Is this simply us pricing in the risk of tariffs being applied to Europe by the Trump administration, despite the fact that Europe wasn't even mentioned in the post that we saw yesterday from President-elect Trump?
Already some sensitivity, though, that we're seeing in the French markets, as the futures picture suggested earlier. Your biggest index contributor to the downside is LVMH. It's luxury. It's the read-through there. As Guy mentioned, we're still waiting on some of the German names as well. But when you look at some of the tech sector for Germany, I'm looking at SAP, for example, is one of your downside movers. Anna, ASML is one of your downside movers when it comes to the tech space. I'm curious how much of that is the China exposure as well. And on top of that, this to me is the Trump trade very clearly, and that's BBVA. That has so much Mexico exposure. It's getting hit pretty aggressively and dragging down the stock 600 with it.
Yes, and you can certainly see when you look at the broader sector picture, everything is in red. No sector is in positive territory right now. Autos and parts, as expected, that is an area of weakness, and that is the worst performing sector. Stellantis, Valeo, BMW, Volvo, all down by more than 1.5%, as is Mercedes. So broad selling across the auto space. And as we said, is that some of those companies do manufacture in Mexico, but there is just the broader thinking. If we look at other sectors that are in focus, consumer products and services is weaker. There's Compass in there, and that was one of the ones that we talked about at the open. That particular business down by 3%.
LVMH is down by 1.6, biggest points drag on the stock 600 this morning. So maybe this is again the area that Trump may focus on, or market extrapolating an area that he may focus on. The bigger question here is, though, I keep talking to guests and they keep telling me that all the bad news is in Europe, that Europe is super cheap, that this is as bad as it gets, but it keeps maybe getting a little bit worse.
Yes. Well, this is a really interesting question. The extent to which markets have priced in any geography what a Trump presidency means, because knowing what a Trump presidency means is very difficult. And if you price everything, if you price in word for word, surely that is not priced, is it? I mean, this would be something we continue to have conversations about.
Well, as we speak, the DAX has opened, I feel like a minute earlier than it usually does here, but you are seeing, of course, the car sector really take a beating this morning. So Daimler Trucks is your biggest percentage drop that you're seeing in the German index, down by about 3%. But BMW, Volkswagen right on its heels. You are, however, seeing defense stocks actually in the green in the DAX. So that feels to me like a Trump trade right there.
That seems logical, doesn't it, though? In some ways, this again is an idea that Europe is going to have to stand on its own 2 feet.
I'm sorry, is the market right? What?
The market's always right.
Well, let's bring in a guest who can maybe give us a little bit more insight here. Julius Bendikis, Europe head of macro and dynamic asset allocation over at Mercer, joining us around the table. I'll put that question to you. Is the market right, or are they overreacting?
I think European equity market is reading into a lot of things right now, but I think it's fair that it's actually underperforming. And I've been trying to solve that puzzle all morning myself, but I think when China coughs, Europe catches a cold. When US coughs, Europe catches a cold. And right now, the fact that there's conversation around more tariffs on China, and the fact that yuan is weaker, that makes Chinese exports a little bit more competitive. So that is a headwind for Europe. Then if there's a headwind for China because of tariffs on Chinese growth, that is a headwind for demand for European goods, and that's why you're seeing a bit of a pullback in luxury stocks. You also have the French politics, which could be a bit of a headwind on market. And at the same time, when US applies tariffs on other countries, that is also a headwind for the US growth. And Europe depends on US demand. So I piece these things together, and it sort of adds up to a bit of a pressure on European stocks, which I guess that's why maybe they're pulling back this morning.
Well, as we speak, you kind of talked about the fundamentals there and piecing it all together. At the same time, we are getting headlines from the ECB's Guindos as well, talking about that weak growth is one of the main risks that they see now. They're again talking about getting inflation on target. Is inflation still a problem right now, or has the narrative shifted?
I think in Europe, inflation is a problem broadly resolved. The labor markets are rebalancing, and there's certainly, downside risks to growth, which could lead to lower inflation and therefore trigger a more dovish ECB. So I think in European inflation is a problem resolved. I think global inflation, particularly the US inflation, is a problem being resolved, but there's some risks to it, as you might expect coming into next year because of the new administration.
Julius, what do you think? Help us understand what is and is not priced when it comes to trade tariffs around the world, because the market, I guess, knows better than to take every statement on tariffs at face value and price that in directly. And so that takes us to a situation where some argue that tariffs are priced and others argue that tariffs are not priced, and they both could be right, but they're arguing it from different perspectives. What do you look for the market to price in on the tariff front?
I guess right now market is pricing the risks around it. No one can be certain because, numbers can change. So it depends on actually when things get announced, then the market will be very sure. Right now it's just speculation, and every day the narrative changes. So I'm just looking, for the volatility around the narrative, tweets, and all of that will trigger just market vol. Do I want to make a big directional bet on a tariff right now? No.
Right.
I think the market has priced in quite a bit, but probably not fully.
But do you know enough about the Trump administration and its priorities to come up with a strategy around, for example, European stocks? You know, maybe not this sector, because this sector is going to be hit by tariffs of some magnitude. Maybe not this sector because some other impediment will find its way there. What are you thinking about when it comes to European asset allocation and Trump?
I try to design a high-level sort of vision for what the administration might do. Stuff on tariffs, stuff on immigration, stuff on global politics and geopolitics. And it's still a fairly broad picture, so we don't know where we're actually going to land. So right now, I would say I'm being a bit more cautious, and I'm not making major macro bets on Europe, whether it's in equities or bonds, and pulled back that risk over the last couple of months. And then I'll react as things evolve, because right now it's still a lot of uncertainty. It is much more than before, and we have to take a few pages from the playbook back from 2016. And at that point, being a little bit more cautious was probably the right thing to do.
We're all focusing this morning on the risk that Trump poses to Europe and the threat that comes from the United States. Isn't the danger inside the house for Europe? Shouldn't we be looking more internally to the risks that currently are posed by European politics? Germany's all over the place right now. There's a note out this morning from Steve Barrow over at Standard Bank, too big to bail, talking about a Greek-style situation in France and how you could see political collapse followed by a debt crisis that could really roil European markets in a way that we haven't seen for a very long time, and maybe even greater than what we saw in the European debt crisis. Are we underpricing the risk in the house rather than the risk outside the house?
Well, there's always something wrong with Europe. That's the old adage, and let's just remember that.
But this is quite a big. This feels like it could be quite substantial.
I don't have too much sympathy with sovereign debt crisis number 2.0, but never say never. There's risks, but at the high level, I think yes, politics are not great. There's a lot of sort of divided. There's not enough political will to do structural change. And I think European manufacturing sector is weak. And there's a lot of risks coming from the trade and from China.
But people talk about all the risks being in, that Europe is super cheap, that equity markets here are... We've never seen such a huge spread with the United States, and it can't get any bigger because valuations are rock bottom right now. Do valuations get cheaper if the French government falls by Christmas? Is the potential for... Or does that just get felt through the currency channel? Does it get felt through the equity channel as well?
I suspect it could be a little bit of both, but you're right in saying that European equities are very cheap. And if there is a ECB that is very dovish, or if there is a sort of negotiated trade war truce, there could be a cyclical pickup in European equities versus others, and there could be a real catch-up.
Is that a tail risk or a central?
I would say there's more a risk around the corners rather than something I would bet on centrally.
Okay.
However, Europe can outperform, but for it to catch up properly, you need to see structural change.
Do we still need to be factoring in what happens in the budget? I mean, Guy kind of talked about that a little bit in terms of France and the ripple effects there. You mentioned a financial crisis as well. It feels like that narrative has completely come off the table.
I think the risk is there. There's going to be a lot of volatility around it, and the spreads between France and Germany can be
But people aren't trading it. They're like, I mean, it feels like a very complacent area relative to the volatility elsewhere. Again, to Guy's point.
I guess the market has a lot of big fish to fry right now, and probably French politics is downright the pecking order with the new administration, China response being top of mind. So maybe there's something the market is overlooking, but again.
I think we fry fish, not the French, but yeah.
How inflationary a world are you preparing for then, Julius? Just broadly, there's been a lot of conversation about what Trump will mean for inflation, but even before a Trump presidency, a lot of people were lining up reasons why inflation might be more elevated than it was, post the GFC, and we will never go back down to those kind of levels of inflation. What are you preparing for?
Well, before Donald Trump got elected, I was lining up for disinflation to continue because I had a lot of confidence that the wage growth is indeed coming down. And from the conversations with our careers team in the US, that narrative is reinforced, with executives penciling about 3.5% wage growth. When that happens, that is consistent with inflation at 2%. So I was very comfortable with the disinflation narrative, and I was certainly pushing back on those who argued higher for longer for inflation. If anything, you could argue for higher for longer for rates to ensure that inflation is there, but I wasn't too worried. Right now, I think there's some risks around the edges. coming from tariffs, there could be a one-off pickup in prices. If there's a big disintegration from the US, there could be some pressure on wage growth. And fiscal stimulus at the time when the economy is arguably close to capacity, that is potentially inflationary. So risks have elevated, but as long as I see wage growth coming down, which has been the case, I'm fairly comfortable.
Nice to see you, Julius. Thanks for stopping by to see us. Joining us around the table this morning, Julius Bendikas, Europe Head of Macro and Dynamic Asset Allocation over at Mercer. Picture doesn't look particularly good out there of your long-risk assets this morning, particularly when it comes to the centre of gravity here in Europe. Let's take a look at the core six and figure out exactly what is happening. As you can see, significant amounts of red on the screen. LVMH seems to have come off its lows, but as you can see, there's an awful lot of weakness out there at the moment. Schneider Unchanged looks like an anomaly. I'll come back to that one in just a moment. Let's get some other moves, figure out what is happening here with Joe Easton.
So it's all about those tariffs today, Guy, particularly over on the Mexico exposed board here. As we said earlier, BBVA does have big Mexico exposure. It did drop after Trump was elected, so that one coming down 2.4%, as is AB InBev, the big brewer that has Mexico operations. Tenaris in the metal space, and also Daimler Truck, all of them with Mexico exposure. Daimler Truck in particular exposed to Mexico, coming down 4.3%, but the auto sector in general is weak today on the broader Trump concerns, of course. Then we will flip over and check in on the drink sector more broadly, because I also wanted to mention Heineken, which does also have some Mexico exposure, and Diageo and Pernod. Potentially that part is more related to the China risks around the tariffs there, given the big market for both of those companies. So really all about the tariffs today. Then in terms of the single stocks, we have got Roche on the radar, and there it is coming down. They've done a takeover deal today over in the US, but also weak lung cancer drug study results. They have missed the primary endpoint, and that's weighing on that one this morning. And also in the UK, we're looking at Compass. That one was called lower by analysts over at Morgan Stanley, and they've been proved correct, because that one down 2.9%. That is a strong and steady stock. The airport catering, office catering company, no buyback is the comment from Morgan Stanley that seems to be weighing on that disappointment around capital returns for Compass. Then finally, wanted to bring up this morning call on a Monday, because this relates to the Italian banking news that we had yesterday. Now, Amundi actually has a deal with UniCredit on asset management, and analysts over Exane is saying that this pact potentially comes into focus under threat if the deal between UniCredit and BPM does go through. So they've got their eye on that one. And Amundi falling today, down 2.5% over in Paris.
Joe, thank you very much. Joe Easton from our equity team there with a look at some of those analyst moves and indeed other stocks and sectors. And I'm glad he pointed to the drink sector, because I'm not sure we've given that one enough coverage this morning. 8:13 here in London, 9:13 if you are over in Germany, and it will be to Germany that we will go next. Germany's industrial downturn deepens, with ThyssenKrupp steel unit planning to cut 40% of its workforce. We will feed that into the wider conversation of German industrial woes. That coming up next from Berlin. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Welcome back. You're watching the opening trade, 17 minutes into the equity market session. This is what we're looking at across Europe. It's interesting, actually. It's a reasonably even story, as you can see, in terms of how we are trading and kind of the evenness across Europe, I think, is fascinating. The market is just pricing Europe as a kind of blob this morning. It is exposed to the Trump tariff trade story. There are some specifics around what is happening with luxury. There are some specifics around what is happening in the auto sectors we've been talking about. But Europe is being, despite not being mentioned by Trump, heavily impacted by the Trump story overnight. This as we continue to watch what is happening with French and German politics, which in some ways are big stories in Europe that aren't being talked about a great deal. So let's talk about them now. Alan Katz is in Paris. We need to talk about what is happening with this French budget and whether or not the French government, the current French government, survives until Christmas. Ollie Crook is in Berlin on Germany's macroeconomic troubles. Let's start with you, Ollie, and talk about what is happening here. More bad news. It keeps on coming. The latest being the German conglomerate ThyssenKrupp announcing plans to reduce staffing at its steel unit by 40% over the next decade. Just reflecting in some ways the challenge that so many of these big German industrial companies face right now.
Yeah, Guy, and not just reflecting it in sort of a broad sense, reflecting it in a very real sense. Because again, we've talked about it for, a number of years now, more than 2 years, manufacturing contraction in Germany. We look at the PMI charts. We sort of have an illustration of what that means on paper. Again, what we've got in the last couple of weeks is that being illustrated in the real economy, ThyssenKrupp being the most recent. And we're talking huge numbers here. We're talking about 11,000 job cuts over at ThyssenKrupp that as you said, 40% of the steel unit. That comes after Friday. Bosch announced 5,500 job cuts. A few days before that, it was Ford in Europe, 4,000 job cuts. And then that doesn't even touch the Volkswagen job cuts, which are going to be probably closer to 10,000 to 30,000 job cuts. So in sum, we're talking somewhere between sort of 30 and 50,000 job cuts, broadly speaking, across the German economy, announced over just the last couple of weeks. And these are not small companies, right? These are companies, many of whom that have been operating within Germany since the 1800s. Trying to appraise where we are in the cycle is the question that I'm asking myself. Where are we? Are we at the beginning of job cuts? Are we sort of towards the end of it? I talked to Carson Bresky yesterday, who's really been sort of out in front on analyzing what's been happening in this economy, really got it right, a couple of years back. He says he feels that we're right still in the center of this. There is still more pain to come. We still, for example, have not heard from BMW, from Mercedes. We haven't had any job cuts there yet. And I think another thing to pay attention to is it's not just the big companies. We had an EFO survey out a couple of days ago. The share of German companies, remember, SMEs are huge in Germany, huge part of the economy. So the share of German companies that fear acutely for their economic survival has risen to 7.3%, up from 6.8% just last month. So again, this is sort of continuously on the downturn and hard to see an exit anytime soon.
And how is this going to shape the election or be reflected in the election then, Ollie? Because it must be part of the overall national narrative at this point.
Absolutely. I mean, I will say that I probably wouldn't want to be the incumbent coming into this election with a couple of weeks to go and basically, tens of thousands of job cuts coming in. It will really speak to some of the detractors of Olaf Scholz, the SPD, and the coalition, saying that they've basically mismanaged the economy. I mean, this could go a couple of ways, right? On the one hand, this could really help these sort of Germany first parties, the far right, the far left, really saying that Germany needs to prioritize itself. It needs to push everybody away and really needs to continuously, focus on itself. That being said, the AfD and the far left, they don't really have these sort of economic chops. They don't have the reputation for dealing with the economy. So likely this could continue to support the CDU, which you can see is still sort of way out in front consistently. The problem is that Merz is basically, in terms of his growth philosophy, it's basically cutting tax, cutting bureaucracy, cutting regulation, cutting benefits, cutting pensions, but that does not fix the underlying problem here. The underlying problem here is that there is not the export markets that there previously have been for the German economy. And when you wake up and you see the sort of tweets, or I should say the Truth Social post by Donald Trump slapping, potentially tariffs at 10% on China. You look at Mexico and Canada. I mean, Germany has been really enemy number one for the Trump administration the last time around. That does not bring any sort of reassurance. So the question for the Germans here is, yes, you can have these sort of tweaks here on the taxes and this, that, and the other. That could boost growth in the medium term. What you're failing to have is owning an industry that's really following into the future, particularly with the auto sector falling behind on EVs. And that is what the Germans need to sort of determine. What are they going to be competitive with the Chinese and the United States? And that is a question they have not yet answered.
Industrial concern in Germany spilling over into politics. Politics in France maybe spilling over into industry. Ollie, thank you very much indeed. France's far-right leader, Marine Le Pen, renewing her threat to bring down the government in a no-confidence motion over next year's budget. The move, of course, compounding uncertainties that are pushing up measures of risk on bond markets to fresh highs, the spread between OATs and Bunds. We're joined now by our Paris bureau chief, Alan Katz. Alan, is it now the base case that Le Pen is going to bring the government down, she will vote against it, and the Barnier government will be gone by Christmas?
I would hesitate to say there's any base case. It's really unclear what her ultimate goal is. The reason being that for several months, Le Pen and her troops sort of said, we're going to be responsible people. We're going to, we're not going to bring chaos to France. And then suddenly, in the last couple of weeks, she's really shifted, including yesterday, to a much harder tone, suggesting that she could, in fact, as you mentioned, bring down the Barnier government over the budget vote in December. And the question is really, to what end would she do that? And it's not really clear how it would help her. Now, on the sideline of this, there's a separate court case against her, which the judges could rule that she would be ineligible to run for 5 years, which would throw up into question her presidential ambitions. Is that what's sort of pushing her to be harder, or harder against Barnier? That's possible, but the question again is, how does it really affect her, unless the goal is really just to remind everyone in France, judges included, how much she matters right now. And that could be the thing that's sort of pushing her to do it, or at least to threaten it. It doesn't necessarily mean, though, that she will actually do it, which is why I come back to the issue, I'm not sure there is a base case. We really don't know how she's going to play this at the end of the day.
So, Alan, what does Michel Barnier do in this situation? What can he do to get this budget across the finish line?
So he will probably need to give her some sort of fig leaf, right? He will have to. The budget right now is with the Senate. There will be the French equivalent of what in the U.S. you'd call a conference committee, where they sort of negotiate between the Senate and the lower house, which is called the National Assembly in France, to try to come up with some sort of compromise solution that will probably not really go anywhere, and then the government will be able to pass it through this constitutional measure called a 49-3, which allows it to just adopt the thing without an actual vote. And what that allows you to do is you can adopt essentially any version of the budget that you want, either the very original version that you put in, or something with a few amendments added in. It's as you like. And so in that process, he could then add one or two sort of little budget gifts, essentially, to Le Pen in order to say, look, I've agreed to your desire for this thing or that thing, therefore you should help me out. And that would allow Le Pen to say, look what I got out of the Barnier government too. So that might be a solution. That said, she might say, no, I'd rather actually have you overthrown and sort of recreate political chaos in France. It's really hard to tell.
Alan, you may give us a really good explanation, including talking about the court case and asking lots of questions about why her thinking might have changed here. But her thinking up to this point has been, we've been trying to reinvent the National Rally, the National Front as was. We've been trying to reinvent it. We want to present ourselves as serious. Therefore, the idea that we would just rashly bring down the government, maybe that's not the thing we want to do. We want to keep our powder dry for another presidential election. So do we sense that thinking has changed?
Again, it's really hard to tell because it could be just purely brinksmanship on her part with the idea of saying, I just want to remind people how much the National Rally really matters and why it has become the kingmaker, because you have this left bloc that's in absolute opposition to the government. They'll vote to try to bring down the government at any point, and so that leaves the RN as the kingmaker. So it could be just bluster, essentially, or it could be serious. And again, France doesn't have a real history of parliamentary, well, not in the last 70 years. For a long time, has not had a real history of parliamentary democracy. It's been much more like much more of a presidential system. So it's really it's uncharted territory for France for quite a long time.
Okay.
So it's really hard to tell how people will act.
It really is. Alan Katz, thank you so much for providing us with that explanation from Paris. Coming up on the programme, we're going to talk about digital assets, their future in the UK, regulation behind them as we get ready for another Trump presidency. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
This is the opening trade. We're about 30 minutes into today's session. Red across the screen. It feels like this is, of course, a reaction to what we're seeing from President-elect Donald Trump in the United States and his comments around the tariff story. Now, he hasn't specifically mentioned Europe yet. He's talked Mexico, Canada, China. But it feels like Europe is taking the brunt of the market reaction, specifically when it comes to luxury and the auto space. Euro Stoxx 50 down by about, well, we'll call it 1% if you round up. FTSE 100 right on its heels, down by about 0.5%. There's a lot going on in terms of how we navigate all of this. The UK seems to be a little bit of a relative safe space, and I really underline the relative safe space when you talk about this market reaction. I wonder how much of that will change in the coming months. I want to stick with the UK, though, and talk about the most powerful business lobby that has warned the government that it is in danger of losing the trust of corporate leaders if it fails to mitigate the impact of last month's budget. But Chancellor Rachel Reeves has defended that very budget. She told the CBI's annual summit in London that it was important to put the public finances on a firm footing.
I've had lots of feedback on the budget, but what I haven't heard is any credible alternatives to what I did to put our public finances on a firm footing. What I am really clear about, and I've said it already a couple of times today, that public services now need to live within the envelope that we've set. We will not be coming back to top up those budgets. We have set the envelope for public spending.
Got a little bit more reaction off that. Bloomberg's UK correspondent Lizzie Burden joins us around the table. Lizzie, walk us through the reaction there.
Well, it was negative. I mean, I was at that conference last year and Keir Starmer was a rock star. That was, though, when he was in opposition. Now, of course, they've had the budget, £40 billion worth of tax rises, most of that aimed at employers through this national insurance contributions rise. And so the CBI chair, Rupert Soames, is saying you've got to make up for it somehow. And that's why today, in part, we're going to be getting the white paper, Get Britain Working, and Keir Starmer is going to be saying, look, we'll take away benefit spending from people who refuse education or training, and the goal is to get employment to 80%. It fits the message from Rachel Reeves that you heard there of fiscal responsibility, but, you know, it's going to be controversial within the Labour Party in some parts because ultimately that message is, as I once said to you, Guy, get on your bike.
And I did.
And he does, yeah, regularly. Yeah, we witness. Let me ask you about the BOE Watchers Conference, because that was also happening. So the Bank of England Watchers Conference in London yesterday. Were there any clues there about the impact of an incoming Trump presidency?
Yeah, it was really interesting to hear finally from Swati Dhingra on this, because she is the resident trade expert on the Monetary Policy Committee, and she says that because of trade being diverted from China, actually for the UK it could be disinflationary. We also had her joining this collective rant on the UK labour market data. She was born in India, and she says if India can get its jobs data sorted, the UK certainly can, because at the moment it's in the way of the policy making. We also heard from Claire Lombardelli, the Deputy Governor, first time she's given a speech since being on the committee, very much stuck to the script of the last meeting's minutes, saying yes, they're making progress on disinflation, but the risks are balanced, so they're going to be data dependent. But interestingly, the main thing she was talking about was the Bernanke review, because she's in charge of executing it. She says they're not in a rush to do anything about it, but hinting firmly that she's not up for copying the Fed's dot plot.
Lizzie, thank you very much. Bloomberg's Lizzie Burden with the latest on those UK themes. Sticking with the UK and regulation, regulators are aiming to finalise rules to oversee the crypto sector by 2026. This as the country tries to keep pace with developments in the US and in the EU, and as crypto ownership in Britain continues to grow. We're now joined by, for an exclusive conversation, by Matthew Long, Director of Payments and Digital Assets at the UK's Financial Conduct Authority. Matthew, thank you so much for joining us. And you put out a report this morning with details of the UK and its relationship with crypto markets. In there, we see 12% of UK adults now own crypto products. This is ticking up slowly. Just spell out for us, because I think it's useful to keep saying, how much protection do those holders of crypto assets in the UK have right now?
Yeah, thanks very much for having me this morning. At the moment in the UK, there is a money laundering regime and some financial promotions protections, but there are no protections for those that invest in crypto. So, unfortunately, if people do invest in crypto, our message is be prepared to lose all your money.
Be prepared to lose your money. Well, that's an interesting place to start our conversation. And I'm taken by the fact that, you know, you've been doing this for a couple of years now. Your background is in financial crime. Is that where your priority is then when it comes to regulating as opposed to incentivizing the crypto industry?
Not at all. I mean, any regime has to take account of all of the different ways. We want a safe market and we want consumers to be protected. So what we're delivering is a regime that started with money laundering, because that's where some of the threats were. It then moved into financial promotions. We're making sure that customers could see good messages and safe messages, and then we move on to the wider regime. So the wider regime, as you've said, is coming in 2026, and throughout next year, we've got discussion papers where we're discussing with industry how we're going to build a great regime, and then also consultation papers where we're going to say what the rules might look like and give people the opportunity to comment. So I've had many really good conversations recently with industry about how we're going to learn from MiCA, learn from other regulation around the world, and bring a great regime for the UK.
Matthew, is the UK behind the curve? The Americans are talking about a strategic stockpile of Bitcoin. We're still dealing with the kind of regulations that are going to protect retail consumers. We appear to be kind of watching everybody else make the running on this. Why is the UK taking this more circumspect strategy, dealing with this more circumspect strategy that you're outlining?
Yeah, I don't think we are behind the curve, and I don't think it's circumspect. I think what we've done is we started with stablecoins as the previous government asked us to. That's now been moved into one regime by the current government. So we're responding as we would as a regulator to the government requests, but we're working directly in the global market as well. So I currently chair the IOSCO work on behalf of the Securities Organization, which includes the US, includes MiCA countries, and within that we come up with 18 global recommendations which we're implementing globally. So so what we're delivering at the moment is a regime in the way that we've described it that will be ready and good for the UK. But I directly work with the US and directly work with MiCA colleagues.
The other day at the Mansion House, the Chancellor talked about the fact that regulators maybe were standing in the way of growth. Is that a message that you've heard? Is that a message that you think regulators more broadly should be hearing?
So as a regulator, we have a secondary objective for competition, and it's a key part of what we do. We absolutely are committed to competition. In terms of growth, our job as a regulator is to make sure we're taking account of growth, and it's one of the things that we've been written to by government to make sure that our plans include it.
Matthew, it's Creedy in London. Talk to us a little bit about how the crypto story and the crypto regulation comes either in tandem or in contrast to some of the moves in central bank currencies, CBDCs. We know that the digital pound is something that the BOE is talking about. A digital dollar, certainly something the Fed is talking about. A digital euro already exists out of the European Union. How are you viewing the contrast between CBDCs and crypto?
So in terms of the direction of CBDCs, you'll see that the government has particularly asked the Bank of England to do some work on that, and we'll directly work with the bank in that. We also consulted in our regime about stable coins and then systemic stable coins. So obviously what we're making sure is we think about the role of stable coins and CBDCs. So ultimately we support the work of the Bank of England on CBDCs, but we've also looked at other options which are stable coins and how we would work between both the conduct regulator and then ultimately the Bank of England.
So Matthew, I'm going to continue with that concept of kind of international currencies as well. There's a lot of foreigners living in London, myself included, who are looking at a weakening pound as well and saying, well, maybe, this is not my personal view, but this is one that exists in the narrative, maybe if you are looking at a dollar strength and you're an international investor that's being kind of affected by that, maybe crypto as that store of value is the place to put your money, except the government or regulators like yourself are getting in the way. How do you respond to a question like that when other currencies, more traditional currencies, are weakening?
Yeah, I understand particularly the challenge that you're facing and the discussion that you're having. Ultimately, we haven't got a regime yet. So we haven't got a safe market from our perspective, and we haven't actually got the consumer protections that we think you would want to make investments. So that's why, unfortunately, our message is still about buyer beware. If you are going to invest, you've got to be prepared to lose your money. What we are doing, though, is making sure through the money laundering regime and the financial promotions that we are putting good safeguards in place. And as we get towards 2026, there will be a better market and more protections for you. So my message at the moment is still be very careful with any investments you make, as any investment, but particularly in crypto, because we haven't got the protections that you can afford to in the UK.
Well, Matthew, you mentioned that kind of buyer beware dynamic, and we've seen this show up in the likes of exchanges. For example, in the United States, Robinhood has come under a lot of scrutiny about this, given their exposure. Are you partnering with the likes of Robinhood, among other kind of crypto exchange operators, to help create that education? What does that dynamic look like?
So, of course, I won't make a comment on any current applications or any activity with particular firms. But what I will say is that we are meeting with all of the significant industry bodies and the industry partners to work through what the regime should look like. I think that it's really important that when we build this regime that we've taken forward what is going to be helpful for the country, but particularly also that we think about that dynamic where companies are based all around the world. So we have to be open for good regulation globally.
So back to where we started the conversation, in a sense, Matthew, the fact that we see increased ownership of crypto by adults in the UK. Are we seeing this normalisation of crypto ownership taking place in a way that the FCA is comfortable with, or is that a decision for government?
Yeah, it's not a question of whether I'm comfortable or whether we're comfortable. It's a question about our research is so that we can keep our finger on the pulse in terms of what consumers are doing and make sure that we prioritise where we can make consumer activity safe and also take into consideration what the market should look like going forward. So I think it's really important that this research tells us today the volume of people and that we respond to. That's why we do the research, so that we can have conversations with you today to actually get our message out and make sure we build a really good and safe regime.
Thank you very much, Matthew. Good to speak to you. Matthew Long, Director of Payments and Digital Assets at the UK's Financial Conduct Authority. Coming up on the programme, the EU proposes sanctions on Chinese firms as the G7 prepares to increase pressure over alleged support for Russia's war efforts. More on those measures next. This is Bloomberg.
How do we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with, right? So all of a sudden, we're seeing these data points coming out going, my gosh, we're owning this space.
From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to the opening trade. We're about 45 minutes into today's session, seeing red on the screen and continue to talk around some of the tariff impact that we may see out of the United States currently showing up in Mexico, Canada, and China when it comes to those comments from President-elect Donald Trump. Could Europe be next? And what industries get caught in the crossfire? Right now, you're seeing that showing up in the French and the German indexes, auto and luxury getting hit especially hard. But outside of that conversation, there's some other movers you want to keep an eye on, specifically in the banking space and the Italian banking space in particular. Unicredit down about 1%. Banco BPM, on the other hand, higher by 0.9%, all from some headlines, some consolidation, but not consolidation, right, I think is the way to put it.
Yesterday, the story was all about Unicredit making a play for BPM, and we were mindful yesterday in our conversations that Crédit Agricole owns a stake in BPM, and wondering whether that they might have something to say about this. They've been making some comments this morning saying that Unicredit didn't ask permission to exceed. They have not asked permission to exceed their 10% stake in BPM. So that doesn't suggest perhaps that they're in a rush to come forward and make some kind of counter offer. But there is a lot of chatter, and this is being picked up by the Italian media, about whether Crédit Agricole themselves might have somehow, through some derivatives, again, this is all rumours on trading floors, quoted in the Italian media, but it does seem to be moving the share prices, whether they have increased their stake in BPM.
We don't know.
A lot of smoke.
A lot of smoke. How much signal is there in the noise around all of this? We don't know yet. We were caught by surprise by the Unicredit move once again. What does it ultimately do? I suspect the Unicredit has its objectives here. We don't know whether it's Commerzbank. We don't know whether it's BPM. We don't know. It could be another bank entirely. It does seem as if Orcel is on the move at the moment, and certainly that's having an effect. But how does everybody else react to it? Is he the Donald Trump of European banking at the moment, catching everybody by surprise and basically kind of forcing everybody to react in a way that they hadn't expected to? Or is Crédit Agricole already looking forward to this and is positioned for it? I don't know. The market is really struggling with who is defining the narrative at the moment, and that's been the story of this morning. Who's in control of the narrative? In Europe, it seems to be Donald Trump. In European banking, it seems to be Andrea Orcel.
I'm going to nerd out here. This, to me, I'm having so much deja vu around the BBVA Sabadell deal, because ultimately it's coming out to, we want the bigger markets, we want exposure internationally, except you get in trouble with your homegrown government. And this is a very story you're hearing from the Italians. You heard it from the Spanish as well. You heard it from Germany. We're talking about in the break about how you're starting to see kind of protectionism, but on a different level.
Yes, but I suppose there's one difference here. Maybe there's a difference here in the sense that what Orcel is doing hasn't necessarily got the blessing of the Italian government. So he may be loading up on Italian assets here, or trying to, but it runs counter to another plan that the Italian government had, which was to create a different force in Italian banking. We've heard from the Italian finance minister that they have not given their blessing, nor have they withheld it, but they haven't given a verdict yet on what they think of this.
Why don't governments want domestic consolidation? Is it because they want to have enough competition within their domestic markets, so that actually there's good price competition? In theory, though, cross-border would solve that problem, but it does seem as if European governments are still very wary of cross-border, which makes you it does slightly take me back to the financial crisis and the Eurozone crisis, where that kind of spillover effect from other people's financial crisis was something that Europe had to deal with. And I think a lot of politicians in Europe still bear the scars of that. Why should I take on your banking risk into my markets? Why should I have the spillover effects of your banking? And that, it just speaks to this crisis at the heart of Europe, which is we don't have this single market in a way that you would envisage, which is why we're struggling to make this thing work.
Next steps here, post the government say is whether or not the ECB gives it their blessing as well. Because at the end of the day, the concerns around this from the domestic side is, yes, we don't want too much international exposure to domestic banks, but you also have that read-through into consumer rates. For Germany, it's an overbanked space. For Italy, for Spain, these consolidations make an active difference when it comes to the actual rates and borrowing and consumption factors for some of these countries, maybe perhaps inhibiting some of the outperformance of the periphery. This is all happening in the background. I think the main topic for Europe right now is what's happening in the defense space. Certainly a topic at the G7 where nations are set to increase pressure on China for allegedly supporting Russia in its war against Ukraine. That's according to an early draft of the communique seen by Bloomberg as foreign ministers, as I said, meet in Italy. Bloomberg's managing editor for European economy and government, Ben Sills, is all over this story. Ben, what might we actually get from the G7?
Well, the main thing we're going to be looking for today is confirmation that they've signed off on this communique that we saw yesterday. That's going to be, assuming it comes through, a pretty significant escalation in their stance towards China. Earlier in the year, they were calling on China to take measures to ensure that Chinese firms weren't supplying the Russian military. Now it's the G7 themselves that are pledging to take action. And we saw last night, off the back of that meeting, that the EU is proposing specifically sanctions on exactly those firms, the Chinese firms that the EU has evidence of supplying drones, supplying microelectronics to the Russian armed forces.
Ben, is this a significant escalation, or is this sort of another iteration of what we've heard before? Help us get some size and scope around this.
I mean, this is the 15th sanctions package that the EU has proposed against Russia. So, in that respect, you know, all of the low-hanging fruit, all of the kind of like the most impactful measures have been done there. So it is incremental. On the G7 side, I think that you can see that the split is increasing between the G20 type conversations that we saw in Rio last week, where there is a search for common ground with China, with India, with Brazil, and the rest of the global South, whereas the G7 is very much an alliance in support of Ukraine, and much tighter, and really increasingly willing to show those global kind of dividing lines.
Well, Ben, at the same time, there's a question of how does Europe not only ramp up its defense in the war effort against Russia and via Ukraine, but just for their own defense as well. And some of that is coming out of reporting that France is dropping a buy EU demand when it comes to defense fund. Basically, other international defense makers can access those EU-funded initiatives. Can you walk us through the logic there? This has been a hard line for France for a very long time.
Yeah, I think this basically boils down to the UK. The Europeans and even the French, who tend to have the most kind of nationalistic, most protectionist attitude towards their industry, even the French realised that if you're going to have a credible European defence strategy, you need to include the British. And if you're going to include the British, you need to include British arms producers, British production, British industry. So I think that's the thinking there. And we see that the biggest four spenders in EU defence, that's Germany, France, Italy, and Poland, were meeting with the Brits yesterday, and that, I think, points the direction of travel in that respect.
Ben, great stuff. Thanks very much indeed. Ben Sills joining us out of Madrid. Let's get back to the politics from a different angle. The big story this morning, Trump's tough talk on tariffs aimed at Canada, Mexico, China, not necessarily Europe, but European markets having to price it in. Valerie's back around the table with us. Strange morning in many ways.
Yeah, it seemed like the only asset class that had the clear trade was in the dollar, quite frankly.
Yep.
So perhaps, we can draw conclusions from today's price action that the cleanest way to trade these tariffs is just in FX, right? We had a stronger dollar. If you look at how the Mexican peso was traded, it's now weaker by 1.5% on the session. But a lot of this, we have to remind ourselves that a stronger dollar does stand at juxtaposition to another part of Trump's mandate, which is to bring back U.S. manufacturing, to onshore manufacturing. A stronger dollar is a headwind for that. So maybe a risk, I guess, if he goes and pursues stronger tariffs, that he has to do something, maybe something else to combat this dollar move, else he is going to not be as successful in the onshoring move that he is hoping to see.
And I suppose the other thing, we've been reminded about the way that the market trades headlines, but we reacted really quickly and then saw a lot of the reaction unwind, Valerie, which is probably something we're going to keep, which we might see replay, and something we need to keep bearing in mind as we see more and more headlines from the president-elect.
Definitely. And if we look at how his Truth Social post, when he was talking about the China tariffs, he used the word additional. Does he mean additional to what's already on China, or additional to, that bigger 60% number that he already talked about? A lot of that confusion is still taking place right now with how this shakes out in the markets. But definitely FX volatility, and FX seems to be the cleanest way to trade these tariff headlines.
We will get used to that, and we'll get used to the ambiguity. Valerie, thank you very much. Bloomberg's Valerie Teitel with some of the latest on the tariff story, which is looming large over European stocks. All of the sectors in negative territory today. We see some of the markets most exposed, the French, the German, the Spanish markets, all weaker. Autos and parts is the weakest performing sector. That sector down by more than 2%.
To Valerie's point, though, does the ECB just have to cut rates aggressively to deal with the tariff threat that is coming, and what impact did that have on the euro? It's really going to be interesting to see how this works its way through the system, and the unexpected bits that the markets are ultimately going to have to price in. But this morning, I just find it fascinating that Europe's at the epicenter of the tariff talk when
and China
it wasn't meant to be.
Chinese stocks were up. You mentioned the automakers is showing up in the drink makers as well, not just because one of the reciprocal tariffs from the United States to Europe, it's actually in the liquor space, the whiskey space as well. And so is, by the way, the impact on the China side. So this is where it shows up. You're seeing a bigger hit here where you have AB InBev down about 3%, Heineken, Diageo, I'll add to that as well, Pernod Ricard, and Remy Cointreau both down about 2% as well. A lot going on, a lot of red on the screen, some pockets of green when it comes to things like defense and some of the banking stocks. That does it for the opening trade. The pulse is up next. Probably continue on this conversation of banking consolidation, with President-elect Trump's impact on the rest of Europe and the rest of the world. They're going to dive into that next. Stick with us. This is Bloomberg.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the firing line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Down on migrants and illegal drugs. Now, for more on all of this, let's bring in Bloomberg's Ross Matheson and also Michael Strobeck, Chief Investment Officer at Lombard OJ. So, Michael, thank you so much for joining us. Ross, there's a lot to talk about because the market was kind of in a wait-and-see situation. Let's see if Donald Trump will really impose tariffs. Is this a negotiating starting point because he wants a deal, or does he want tariffs?
Well, certainly this seems to be the opening gambit. It's interesting to see also what he's tying it to, because this is not him saying he's going to put tariffs on China or Mexico or Canada because of economic policy or corporate behavior. It's using tariffs as a lever for political policy to say, well, I want action on migration and fentanyl. I want action on drugs. And if you don't do those two things, I'm going to respond to you by hitting your companies and your products. And so it's using, again, what we saw very much in the first iteration of Donald Trump, is tariffs are not just an economic tool, but they're very much a political and a geopolitical tool. And that's the way he's going to see it. So this is probably an opening gambit. It might be also he saw the response to the nomination of his Treasury Secretary and, you know, all the talk that he might be slower on tariffs potentially than Donald Trump would want. Maybe this is a message saying he would act, although 10% on China is probably something China could live with from the outset. But certainly it's just the opening salvo. He's not even in office yet. So what this means is countries like China, Canada, Mexico have, you know, a few months at least to think about how they would respond in actuality if this does happen.
I mean, Michael, the problem is that, again, it's difficult to look at policy. This is not, I mean, it's policy, but actually it's more of a negotiating tool.
Yeah.
So how do you, I mean, as a market participant, how do you make sense of it?
Well, he is using it as an all-weather tool for obviously getting to results that had nothing to do with economics. what it does is it puts pressure on currencies. Tariffs are messing up with the terms of trades of countries in ways that firms are not prepared for long term. Short term, therefore, you're on the losing end if you get hit by tariffs. And the expression of that is actually a strengthening or weakening currency to balance out the terms of trade.
But Michael, I mean, I have many questions. First of all, do we know, is this inflationary? Because again, there's many questions. If you're hit by tariffs, does it hit growth first or inflationary? Because that will change the reaction function of central banks.
It very clearly first hit inflation, and then depending on how effective it is in, let's say, the US, it may or may not hit growth, but it clearly protects US companies for a period of time from import from other places.
Raz, is it too soon to infer some of the other policies, given who he's put in his cabinet?
Well, it's very hard to know because some of them have to be confirmed first, although we'll see even by the replacement of his nomination for Attorney General, the replacement nominee is also very loyal to him, someone who's been a conservative lawyer in his orbit for many, many years and someone who will faithfully enact his policy. And so what he really wants, either way, is people who will enact his policy perhaps slower than he thought. And again, with the Treasury Secretary pick, Besson is clear, he's a fiscal conservative, and so he might try and maneuver a bit. But elsewhere, he's looking for total loyalty, or he will replace you pretty quickly. But it's just clear that Donald Trump will, if he sees something he doesn't like or something you do he doesn't like, he will just act accordingly. And it's very clear what he wants sorted or what he says he wants fixed very early on. He wants the war in Ukraine to come to an end, for example. He wants the war in the Middle East to come to an end. And whatever happens, whether it's ceasefires or peace deals that are, not necessarily conducive for Ukraine, he will declare victory and say that that's done because he likes to declare victory on things. And so that's very much the way he's going to operate.
But Raz, do you take every time there's, he says something, do you take it at face value? Because that's going to be difficult for the markets. You either try and say, well, this is what he's going to try and do, and the markets may do this, or do you literally just think, well, he wants this, and he's saying it, so that's what we should model?
Well, that's the difficult thing because Donald Trump can say something one day and the next day say the opposite. So he might say that one day he's going to sit down and talk with the North Korean leader, and the next day he say that he wants war with North Korea or something. So it's very hard to beat. But you have to take him literally each time. And that's the difficulty. But countries in like China, Europe, for so on, what they need to do is look through the very immediate and say, where do we want this to be in 6 months, a year, 2 years? And how do we navigate our relationship with the White House through to that, that noise of the immediacy? So you've got to keep the long game in mind.
So, Michael, how do you deploy capital in this kind of very uncertain world?
Well, follow and don't be on the wrong side of Trump, at least for the near term. I think in this term you need to take him more literal than in the first term. In the first term, he was balancing, trying to find compromises with people in his cabinet that he didn't really like and that were not loyal to him. He's picked a cabinet now that is 100% loyal to him. And I would take it very serious what he is saying. He is saying this now before going to office. That creates, the stakes are being built up for deals. That's very clear, but I would take him very serious.
Yeah.
Having said that, I would still deploy capital on the side of Trump, on the Trump trade, which is US equities, US dollar, actually US rates, which will stay quite high because tariffs are inflationary.
So on dollar, I mean, he doesn't really want a stronger dollar. So actually, this could be complicated for.
Then he should stop talking about tariffs.
Yeah, who's going to tell him? Treasury Secretary or the Federal Reserve?
He's not very. He's quite resistant to advice. So. But he is also sort of a guy that wants to get to a place where he can say, I did this to protect jobs in the U.S.
So, Michael, again, what's changed in terms of your portfolio management since, since he got elected? Have you just gone and doubled down on some of your positions in the U.S., or have you had to move stuff around?
Well, we went overweight equities, and we think Donald Trump's re-election is a reconfirmation of a risk-on environment for the moment. Actually, U.S. growth is going to stay probably stronger, not because of the tariffs, but because of sort of typical Republican policies, lower taxes, deregulation, and he has vowed to invest materially into the U.S. industrial economy, with potentially debt going $6 trillion higher. And that is a boost to growth. It's what we call U.S. on high octane, and you need to be on the right side of that, and that is be long U.S. equities and be long equities in general.
Ross, how much do we listen to, of course, we listen to the Treasury Secretary, but how much influence do we think that he'll have on President Trump?
Well, again, you were just hearing, like, he does demand total loyalty from everybody, but we also know, again, like, he tends to listen to the last word that's said in the room before people leave. And so if you're Besant and you're thinking, what I need to do here is to be the last person speaking in the room and plant that thought in Donald Trump's head right before I walk out the door, maybe that's the only tactic.
And Roz, we're also talking about a possible ceasefire in the Middle East. I mean, what do we know?
Well, obviously, there's been talk for days that we might get to a ceasefire with Hezbollah. This is obviously in Lebanon, not in Gaza. I mean, the possibility of a ceasefire in Gaza seems to be off the table at this point, but we do know the Israeli cabinet is meeting today, the security cabinet. Hopefully, we'll get an announcement later today, but that's just for Hezbollah in Lebanon. It's not for Gaza.
All right, thank you both. Bloomberg's Ross Matheson and Michael Strobeck, Chief Investment Officer at Lombard Odier, stays with us. Plenty more to come. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Season is here.
This earnings season tells us there is more to life than mega caps.
Bloomberg is first to break the numbers.
Let's talk about Deutsche Bank here.
BASF with that big exposure.
We have numbers from Barclays, from Hermes, Anglo-American.
We've got a lot of earnings to work our way through.
With the smartest insights.
I think the BBVA has posted really a very strong set of results today with that bottom line.
Somewhat cautious on Q3, but I think it's in a better place than it was.
Continuing coverage on Bloomberg.
Well, the Fed's Minneapolis president, Neil Kashkari, says it is still appropriate to consider another interest rate cut in December. Now, Kashkari was speaking exclusively to our very own Haslinda Amin. He also weighed in on the impact of Trump's potential tariffs on China.
You know, there's obviously the risks of potential tariffs back and forth between the U.S. and China, which are notable. The other big concern is just the domestic Chinese economy and the slumber that it appears to be in. From our analysis, the heavy weight of the housing sector that has been a driver of Chinese growth for so many years is now appears to be weighing down the Chinese economy and just the struggles that the Chinese economy is facing. And so I'm just something that I'm watching a lot is what the policymakers in China do, and can they get the Chinese economy on a stronger, sustainable growth path, you know, reinflating, so to speak, their housing bubble. Doesn't seem like it's a long-term strategy. So what is China's growth strategy? I agree the potential tariffs between the U.S. and China and back and forth is something to pay close attention to. But I think China's own domestic challenges are also notable.
Do you think that if China's economy remains lackluster, we could see some contagion and other Asian economies and perhaps even further afield may get impacted as well?
Certainly possible. I mean, China is obviously a huge economy, and if a huge part of the global economy just grows slowly, that's obviously going to have an imprint on everybody else. For example, commodity markets would be one of the first places that we would see that, whether it's for steel or for iron ore or other metals or other minerals. So that's something that we're going to pay close attention to because it just matters a lot for the global economy. But then I also think many other Asian economies are linked to economies all around the world. I was just looking at some analysis on where the U.S. imports most of its goods. Of course, China dominated that 6-10 years ago, and China's share exporting directly to the U.S. has actually fallen quite a bit, and countries like Mexico and other Southeastern Asian countries have picked up the slack. And so I'm actually optimistic that other Asian economies could continue to perform well because they're connected to the U.S., they're connected to Europe, to South America. But of course, China is just so large that what happens in China matters to everybody.
Well, that was the Fed's Minneapolis President Neil Kashkari. Well, still with us, Michael Strobeck, Chief Investment Officer at Lombard Odier. Michael, thank you very much for sticking around. I mean, it's not easy being at the Fed right now because you'll probably get into the political, eyesight and the eye line of Donald Trump, and he can't really do much, but he can make your life pretty miserable. Yep. So does that, change? I mean, does that have implications for Jay Powell, or is your longer-term concern actually that they're kind of stuck on rates?
I think rates won't go as low as we could have expected if Kamala Harris had won. That's very clear. We had sort of 3.5 end of next year. Now we're thinking 4. Trump, I don't think will go too hawkish on Jay Powell. He actually reconfirmed him, and Jay Powell's successor most likely is also a Trump sort of person. But Trump, of course, if there is trouble, wants lower rates, and that can stress Mr. Powell perhaps less than it could stress markets because he's trying to interfere with Fed independence, and that is not good.
Michael, I mean, when you look at, again, what he wants on immigration is to get rid of some of the drug cartels. Mm-hmm. Okay, if he gets rid of too much immigration, even the illegal kind, then this will hurt productivity. I mean, this will hurt the U.S. economy, which has done quite okay in the last couple of years.
Absolutely. I mean, immigration is net a positive almost for any country if it's productive labor coming in. But it has become a material political problem in the U.S., especially for the Democrats. And the two reasons why Trump won was really immigration and inflation. Immigration he's going to deal with hard. Inflation is a much tougher thing, and if he keeps talking tariffs, that is going to be probably his biggest challenge. But what he really needs to do is to get cheaper food on the tables of Americans that don't have much money.
But Michael, so this for me is a real surprise, right? Because you see the similar dynamics for inflation going down. Mm. The cost of eggs, I think, has gone up like 3 times in the U.S. to like $18. I mean, something that in Europe, frankly, no country do we see it. Yep. I mean, why is that? Is it the way that the supply chain works, or?
I think it's quite frankly, it's a supply chain problem that has moved its way back. There's a little of what I call profit inflation that really also needs to come down. Yeah. But the problem with inflation is that it expresses price increases. Yeah. We're not talking deflation or price coming down. And it is really ridiculously expensive in the U.S., certain things, when you go there. Yeah. And I'm convinced it's the reason, the second reason why the Democrats lost. Yeah. And Trump may have to be more creative than just slamming tariffs on stuff. I mean, food subsidies, etc., can come on the table here.
What happens to China under Donald Trump, and what does it mean for investment opportunities?
Well, it's the worst possible news for China that Trump comes back in this form with this agenda, because China was slowing down already. China has material structural problem in the real estate sector, and now with domestic consumption because consumers are saving too much. And as we just heard, they need to figure out how to invigorate their economy. I think it can only happen if they stop the slowdown of real estate prices. And they have to keep stimulating in the face of Trump. And he has the stronger end of this at the moment because the one global winning country of globalization was China. And Trump is really, if not deglobalization, he's going to put a brake on that. And that's a problem for China and for Europe.
Michael, thank you so much. Michael Strobeck, their Chief Investment Officer at Lombard Odier, stays with us. We'll talk gold. We'll talk about the UK next when the Chancellor defends her budget from last month, despite a warning from the chair of the country's most powerful business lobby. That's next, and this is Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment. Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
I've had lots of feedback on the budget, but what I haven't heard is any credible alternatives to what I did to put our public finances on a firm footing. What I am really clear about, and I've said it already a couple of times today, that public services now need to live within the envelope that we've set. We will not be coming back to top up those budgets. We have set the envelope for public spending.
Well, that was the UK Chancellor Rachel Reeves addressing the CBI's annual summit in London and defending her budget last month. Still with us, Michael Strobeck, Chief Investment Officer at Lombard Odier. Michael, I know one of your contrarian calls is UK gilts.
Yes. Look, I think what we need to see here in the UK is a responsible fiscal policy that brings the path back to credibility for the country. And I think we're still seeing a bit of a slowdown in Europe in general, UK being part of that, and that's why we have a preference for bonds, treasury bonds, or bonds and gilts.
So talk to me also about Germany. I mean, if you look at, also what the UK is trying to negotiate with Europe, this relies and depends on a very strong Europe. Germany is in turmoil. So I don't know what comes next and what that means for markets, but also dealing with Trump tariffs.
Germany has fallen into the deepest hold it could economically and politically and geostrategically. Germany made itself dependent on cheap Russian gas, went away. Chinese exports are melting or hurting, and for the first time in 25 years, we're seeing material layoffs at the sort of the icons of German industry. And we will have an election next year. I would have hoped it came earlier. I'm not sure it is going to bring much change to the economic situation of Germany, because what Germany really needs is more spending, more investment, better infrastructure, and a firm, if you will, alliance in Europe back with France, and all of this is missing.
So what does that mean very quickly on European equities? Do you still look for companies that export abroad or that have a big footprint abroad?
Solid global business models will, I think, always work, and they also work in Europe. Now we have Trump, he's slamming everyone, he says, with taxes of 10% or more. We are underweight European equities in our portfolios versus the US, because we think it just still needs more time for Europe to figure out its path in this new world order.
Michael, thank you so much, as always, for joining us. That was Michael Strobeck, the Chief Investment Officer at Lombard Odier. Coming up, more on Germany's industrial turnaround, with ThyssenKrupp steel unit planning to cut 40% of its workforce. More on that story next, and this is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Bringing you
up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Stocks fall, the dollar strengthens as President-elect Donald Trump vows to impose additional tariffs on China, Mexico, and Canada. The EU proposes sanctioning Chinese firms it says are aiding Moscow's war effort in Ukraine. More restrictions on Russia's oil tankers are also set to be under consideration. Plus, more economic trouble for Germany as ThyssenKrupp announces plans to cut 40% of staff from its struggling steel unit. So let's get more on the economic downturn in Germany and the job cuts at ThyssenKrupp. It comes as a bleak moment for many Germany's biggest industrial companies. Now let's bring in Bloomberg's Oliver Kirk, who's in Berlin. Ollie, good morning. So how bad are things getting in Germany's industrial sector?
Yeah, Francine, we've been talking about it for the last really couple of years, and every time we get those prints on the manufacturing data, we pull up the chart and we see that it's been in contraction for over 2 years. Last time you had a positive print was back in July of 2022. And again, it's fine to sort of chart these things in the theoretical abstract into the chart. What we have gotten in the last few weeks are absolutely huge job cuts across some of these sort of anchor companies here in Germany, the latest of which was ThyssenKrupp yesterday, saying that they're going to cut 11,000 jobs over the next decade. That's 40% of their steel unit. And that follows just days, Francine, after Bosch said they were going to cut 5,500 jobs. And that followed just days before Ford saying that they were going to cut 4,000 jobs. We still don't have the final tally for how many jobs are also going to go at Volkswagen. There have been long discussions between the unions and management. That could be anywhere from 10 to 30,000 jobs. Again, these are sort of down to the negotiations. But what this basically amounts to when we do this sort of arithmetic here is somewhere between 30 to 50,000 job cuts in very short order to this economy after we have been talking about it for sort of years in terms of the decline of the manufacturing sector. This is where it gets real. The question is, how far through this cycle are we? Are we at the beginning of job cuts? Are we at the end? I talked to Carsten Breschke yesterday, who's really been way out ahead, who's been talking about sort of the warnings here for the last couple of years of the German economy. He thinks we're basically smack dab in the middle of things right now, that there is still more pain to come. We've got it from the sort of manufacturer providers to the automotive industry. We're getting it from the automakers. We haven't heard anything yet from Mercedes or BMW. And the other thing, Francine, we should also mention, it's a lot harder to get a read on some of the smaller companies. When we get job cuts from very large companies across Germany, they make big announcements. What we don't hear so much about are about the SMEs, the Mittelstand. I had this survey out of IFO just a couple of days ago. I think it's worth mentioning that the share of German companies that fear acutely for their economic survival has now risen to 7.3% of companies in Germany. That is up half of a percentage point from 3.8% in the month of October. So again, it's hard to see the sort of light at the end of the tunnel at this stage.
So, Ollie, quickly, how's this going to shape the election?
Yeah, so listen, I wouldn't want to be the incumbent going into this where we're talking about companies slashing tens of thousands of jobs, and that is basically what the ammunition is going to be used against SPD and the coalition, basically saying that they've mismanaged the economy. This could play potentially in the hands of the far right, the far left, the sort of Germany first parties, though their credentials in terms of turning around the economy are not as strong as, say, the CDU. What we have seen is the CDU is continuing to maintain its lead, but again, Merz's sort of formula for reviving the economy is cutting taxes, cutting bureaucracy, cutting regulation, cutting benefits, cutting pensions. These things could help around the margin, but it does not sort of replace the engine of Germany, which is the fact that they just don't have the export markets that they used to have. And when you wake up here in Germany and you see these sort of tweets from Donald Trump saying he's going to slap 10% tariffs on China, talking to Mexico and Canada about the same, Germany was enemy number one in terms of trade for the Trump administration part one, so they're just waiting for their turn.
Ollie, thanks so much. Oliver Crook there in Berlin. Now, G7 nations are set to increase pressure on China for allegedly supporting Russia in its war against Ukraine. That's according to an early draft of the communique seen by Bloomberg as foreign ministers meet in Italy. Now, we're now joined by Charles Litchfield, Deputy Director, and C. Boyden Gray, Senior Fellow at the Atlantic Council's Geoeconomics Center. Charles, so good to speak to you. You're usually based in the U.S. You're usually based in D.C. You've been doing a bit of a European trip, I guess, to get the flavor of what should worry people. Is Europe ready for a Trump 2.0?
I was in Bloomberg, I'm at Bloomberg now, and last week I was at Brussels the whole week, Francine, and they were very adamant, and there was a lot of message discipline on their preparation and on a sense of calmness. It's not 2016. We've dealt with Donald Trump before, and we're ready to make a positive offer to him and show him what has changed. Europe is buying more US weapons, it's buying more LNG, it's tougher on China, and so they're hoping that this is convincing enough to avoid Trump going down an escalatory path on trade with the EU. They're not sure it will work, but they've done a lot of decision trees and a lot of scenario planning.
I mean, I guess that the concern is that we know that Donald Trump wants to speak to Macron, he wants to speak to Meloni, he wants to talk to country by country and almost strike a deal unilaterally. That's not how it works in the European Union.
It's not how it works in the European Union, and I think Donald Trump actually knows that. We've started to hear rumors from the last time he was in power, people are starting to talk about it and saying that sometimes when an individual leader would try to get a favor out of him, he said, well, I'm in a discussion with Jean-Claude, who's Ursula von der Leyen's predecessor. So he certainly does want to use relationships, bilateral relationships, including with some people he knows from his previous time there. But I think he is ready to talk with the European Union about tariffs and about trade. There is a new person there. We don't know what the relationship will be like with von der Leyen. They didn't have much overlap last time. So there is a question on who is the interlocutor. There's also the new council president, who's quite jovial. That could be an option. And then Meloni and Macron will be key players. There's also Mr. Orban in Hungary, who isn't entirely representative of the EU27, and is also quite close to China. So maybe he won't be the best interlocutor either.
So does Europe need to show that they stand with the U.S. against China to get something from Donald Trump?
That's very important. And the EU has evolved on this. They have all sorts of new mechanisms, and they're happy to use them. People watching us will remember the decision on electric vehicles, which is meant to reestablish a level playing field. It's not the same sort of unilateral and quick approach a U.S. president can take. The U.S. president can label Chinese issues to do with the economy as national security and can move fast. The EU has to move as a 27, and the tariffs aren't as high, but they can at least show they're doing something, and that's a very important lens through which Trump will read Europe, how tough they're being on China.
Charles, you're based in D.C. How will Donald Trump be different this time around? He's, formed a cabinet where there are many more loyalists. Does he really want to impose these tariffs, or is it just a negotiating tactic?
I think there will be an increase in tariffs across the board, not as high as some of the campaign was suggesting, and I think China will be quite surprised that the initial promise from yesterday on Truth Social was only 10% and not 60%. And then Mexico and Canada, which no one was thinking about because Trump was the president who renegotiated USMCA, they're suddenly expecting now a 25% tariff. We'll see if that happens. So tariffs will probably increase a little bit, and tariffs on average are quite low, the tariffs that the US practices. They'll increase, and that's bad for US trade partners. It is also a way to get people to negotiate, including with China. There are some people close to the campaign and who will probably go back into the administration who've been telling us at the Atlantic Council Geoeconomic Center that Trump is sort of going to ignore the fact that Biden was there and simply go back to his negotiating stance just before COVID. Phase one. We promised to stop the escalation on tariffs. You promised to buy more agricultural goods. What's happened? Why haven't you done this? And that will be the basis for a negotiation. I'm not sure where it will lead. Hopefully not to too many increases in tariffs, because there aren't that many sectors in which the US can increase tariffs. On inputs, tariffs against China are already high. It will probably have to move on to consumer goods, which will be very difficult for US consumers. There'll be exceptions. On electric vehicles, they're going to go sort of very, very high, and even the Biden administration was going to do that because they perceive electric vehicles from China and connected vehicles as a national security threat. So there's really no limit to where they go on tariffs there.
But does China need the U.S., given all the concerns that they have economically, especially because of real estate? And so will they likely agree to some of the Trump deals?
China is not being too aggressive at this point. There isn't any wolf warrior diplomacy yet. I think the response to yesterday's tweet on Truth Social from the spokesperson of the Chinese Foreign Ministry was just, we're ready to talk. We haven't really started a dialogue yet, but we're ready. So I think subtly that does show you that the Chinese do want to talk and are hopeful that they can get some sort of cooperative agreement going. But Trump, there are a lot of things Trump wants, and he wants to move on to currency. He wants to move on to a sort of very broad-based deal with the Chinese, which I think that will be difficult for the Chinese government to stretch to. So it will be a difficult conversation.
You mentioned currency. We're seeing a lot. I mean, gold rise maybe as central banks around the world getting ready for, if not getting away from the U.S. dollar, certainly trying to buy less treasuries in case of sanctions. Do you see the dollar actually waning a lot in this kind of environment?
Well, the tariffs, the economic textbooks tell us the tariffs will actually drive the dollar up, and it has slightly today. You're absolutely right that long term there are all sorts of uncertainties around the attractiveness of the main reserve currencies, dollar, euro, given that they're the main inventors of sanctions and the main users of sanctions. What does this mean in the long term? Trump himself has said he's very keen on keeping dollar dominance. Said it in his speech in Chicago that everyone paid a lot of attention to. And so I think that it helps us a little bit filter between proposals that are bad for the dollar's dominance and those that are good. So this idea of a sort of market access charge to stop the dollar from appreciating, I think it's quite unlikely anything like that comes in. Something else that might help the dollar depreciate a little, which is what Trump wants, like naming Powell's successor early, so you have a kind of shadow Fed governor, very possible.
Not awkward at all.
But it could happen, and Trump is good at awkward. And second point, you could see the U.S. itself investing in its reserves a little bit to bring the dollar down in the long term. But I think dollar dominance is something Trump is very keen on, and so it helps us analyze what is likely and isn't likely in terms of measures.
So interesting. Charles, thank you so much for joining us. Charles Litchfield there from the Atlantic Council's Geoeconomics Center. Now, Bloomberg understands that Israel's Security Cabinet is to meet at 5:30 p.m. local time to discuss a proposal for a ceasefire with Hezbollah. It follows a new round of shuttle diplomacy by a senior envoy for the outgoing Biden administration. Now, it does remain unclear if Hezbollah will agree to any possible Israeli proposal. So we'll continue looking at Trump economics and, of course, geopolitics. Coming up, we'll speak with the CEO of Gavi on the potential impact of the incoming Trump administration on global access to vaccines. That's next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Welcome back, everyone. Now, President Joe Biden has committed at least $1.58 billion to Gavi. This is an international organization created to improve vaccine accessibility for children living in the world's poorest countries. Now, with Donald Trump taking office in January, what does the future hold for global vaccine programs? Well, Sanya Nishtar, Chief Executive Officer of Gavi, joins us now. Ms. Nishtar, thank you for joining us. I mean, this is extremely important for access to vaccines in many countries that probably need it most. Could the new administration rescind part of the pledge that you had under President Biden?
Well, first of all, thank you for having me on your program. It's a pleasure to meet you in person. In terms of your question, we've traditionally had bipartisan support from U.S. administrations and that has consistently been evident in resolutions where congressmen from both sides of the aisles traditionally have signed resolutions in support of Gavi. During President Trump's past administration, Gavi continued to have support, and I'm cautiously optimistic that that support will continue. Gavi is an organization which delivers results on the ground. It delivers them at very low cost, delivers value for money, impacts several double bottom lines. And if you look at the construct of international development and the objectives that international development should deliver on, as articulated by the incoming administration, they're exactly the ones that we deliver on. Sustainability, value for money, results, impact at very low cost. So I'm very hopeful that we will continue to have the support.
There are question marks, I guess, around some of the picks, for example, for Health Secretary, who's highly, highly skeptical of vaccines. Broadly, it seems that the new administration, or the people that Donald Trump has picked for his cabinet, are also very critical of the pharmaceutical industry. Do you expect heated conversation with some of these members?
Well, I expect evidence-based conversations. Vaccines are the best buy in public health.
Yeah.
That is very widely believed, and that actually is the truth. Yeah. Vaccines have helped halve child mortality since they've been out there. As far as Gavi is concerned, we've vaccinated 1 billion children since we've been in inception, averting close to 19 million lives, accruing close to 200 billion in economic benefits, while having sustainability hardwired into our model. So I'm very cautiously optimistic that we will continue to have support from across the Atlantic.
I mean, beyond the U.S., do you worry about, I guess, increased vaccine hesitancy that we've seen, also emerge during the pandemic and after the pandemic?
Well, I would say that the noise is disproportionate to the actual quantum of the problem. Because, of course, social media, there is a trend that anything controversial or negative on the social media gets a lot more traction than positive and evidence-based news is. So the hesitancy on the one side is totally opposed to the demand that we're seeing from countries. In fact, as the CEO of Gavi, I have a huge line of applications from countries for the malaria vaccine, for the HPV vaccine, for the traditional childhood vaccines. Countries continue to invest in vaccination. This year, for instance, we will get a record contribution of 200 million in co-financing payments from countries. And if vaccine hesitancy was such a massive problem that it eclipsed country demand and government appetite for investments in vaccines, we would be seeing at least a slowdown at that end of the spectrum. That is not the case. And I think as far as vaccine hesitancy goes, it's not all about misinformation and myths. It's also about the need for the right information to be out there, which is what we're going to focus on. And a lot of it has to do with the actual quality of service delivered on ground. So if a woman in Malawi or in Uganda is waiting in a health facility for 4 hours to have her child vaccinated, she, of course, is going to lose faith in the process. So I think part of what we need to work on is also the quality of execution, the right evidence-based arguments in support of this life-saving tool. We call it the best buy in public health.
And on that, can I ask you about Mpox? So we have seen delays. I mean, this is one of the vaccines that people have been most interested in. There's been delays in the rollout of some of the Mpox vaccines in Congo and elsewhere. Are there bottlenecks? Can it be resolved, and how quickly?
Well, before the rollout, I think it's important to bring to bear how the global health entities responded, learning from whatever lessons there were from the COVID-19 experience. So, as you know, when a health emergency strikes, when a pandemic strikes, when a global health emergency is announced, there are different actors that come into play at the global health level, with the World Health Organization as the steward. Gavi is responsible for the vaccine pillar. And we were able to invoke our first response fund for the first time and order the largest consignment of doses in less than 30 days. So that was a very quick response. And those doses are going to be delivered this year. But of course, your question was about rollout, and that is where the complexity of health systems at a country comes in. This is a new vaccine. It's going to be executed with new modalities. It's a complex environment. The DRC in particular, the overall context is very complicated. But all that notwithstanding, the rollout is happening, and I think all put together, countries and the global health entities have responded much faster and quicker and in a much better way than we learning from the lessons of COVID-19.
Thank you so much for joining us. That was Sanya Nishtar, the Chief Executive Officer of Gavi, with very important conversations on vaccines and, of course, health worldwide. Coming up, Claire Lombardelli delivers her first speech since becoming Deputy Governor of the Bank of England, warning wage growth and inflation will not fall as quickly as hoped. More on that next, and this is Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Too early to declare victory on inflation. It's often been said that the last mile may be the hardest, and this is where we are now. This is why I support a gradual removal of monetary policy restriction, and we'll be monitoring the flow of data over coming months so that we can calibrate our policy path as needed.
Well, that is the Bank of England Deputy Governor, Claire Lombardelli, giving her first speech since her appointment earlier this year. She spoke to us at the BOE Watchers Conference in London yesterday, calling for policymakers to move carefully and gradually as they cut interest rates. So let's bring in Dan Hansen. Chief UK Economist at Bloomberg Economics. Dan, thank you so much for joining us. It was great to speak to and actually catch up with the Deputy Governor the first time that she really kind of laid out what she thinks. She's extremely careful in not giving too much away, especially when it comes to whether the budget was inflationary. Yep. But she says, I guess it's not a done deal that inflation comes down gradually from now.
Yeah, and I think that's right. I mean, I think Claire sits... I mean, one thing I'd say is it was great to hear from Claire for the first time. She was my first boss at the Treasury, so it was great to hear from her, and it was a good speech about a lot of things. I was actually very interested in what she was saying about the Bernanke review.
Yeah.
But I think going to your point, I think the evidence we've had up until now is that she's right about the last mile. There's no doubt about that in the UK. I think what's interesting and the way the committee has changed in light of the budget is that there is more. You saw on the screen there are these sort of three cases that they have. Yeah. One is the sort of immaculate disinflation. There are a few people that believe that, but not many of them. There's this sort of middle case, which is the sort of central ground. And then there's this idea that inflation might be structurally higher and therefore interest rates need to be structurally higher. And that's what she is most worried about. And I think following the budget, that's what Elise Bailey is more worried about now as well. And they occupy the centre ground on the committee. So I think that calls for this gradual easing of monetary policy and the point that she made there in the speech.
But Dan, this is ignoring possible tariffs from the U.S. that would be automatically inflationary, would they not?
Possibly. It depends what the UK does. I mean, it depends what the UK does if there were tariffs placed on the UK itself. I think one of the really interesting dynamics, and this is what Swati Dhingra, who's one of the other MPC members, was talking about yesterday, one of the interesting dynamics will be if tariffs, which seems almost certain, doesn't it, that tariffs go on Chinese exports to the US, if those Chinese exports get redirected to the rest of the world and Chinese exporters drop their prices, then the rest of the world could quite possibly be importing a big dose of disinflation, not inflation, but disinflation. I think the traditional thought process is that tariffs, yes, they're inflationary, they're potentially supply chain snarl-ups, again, that's inflationary. But I think there's that secondary dynamic that if there's sort of a trade war amongst, I guess, the rest of the world, that's what the bank will be focusing on as well, just as much as that inflation side and the tariff side that you mentioned.
Dan, thank you so much. As always, great work, of course, leading the team there at Bloomberg Economics on the UK, Dan Hansen. Up next, Bloomberg Brief, Danny Berger and Manus Krajny in New York, and this is Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Hi, I'm Laurie Haynes, CEO and co-founder of Shirar, and I'm really excited to tell you that we are going to be raising funds for Shirar again. After a successful raise in 2023, it's time to scale.
We hope that you enjoy the pitch deck and the financial model. Any questions, please don't hesitate to ask us, and we can't wait for you to be part of Shirar.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Good morning from our global headquarters in New York. I'm Manus Graney. You're welcome to Bloomberg Brief. Let's set that agenda. It is deja vu for President-elect Trump via sweeping tariffs to hit Canada, Mexico, and China with additional levies. The dollar strengthens, stock futures drop. Losing interest for now, Qualcomm cools on a potential takeover of Intel. More on the Bloomberg Scoop coming up. Minneapolis Fed President Neil Kashkari says it's reasonable to weigh another rate cut in December. The latest Fed minutes and consumer confidence on deck today. Good morning. So it is deja vu in the land of foreign exchange. The dollar on seats a move. You've got Canada. It touched a 4-year low in the overnight. The peso back near the lows of 2022. Now, these drops in the Canada and the peso are nowhere near what you saw on the night of the election. The peso crashed by 3.5% and undid that. What is at stake here? Additional tariffs, 10% on China, 25% on all products from Mexico and Canada. This is a politically motivated tariff rather than a deficit-motivated tariff. More on that with our trade czar in just a moment. Where is it hitting hardest? Not so much U.S. stocks, more so on the European complex. The Russell gives back 0.5%. We're flat on the S&P 500. David Costin over at Goldman Sachs says, keep your money in U.S. stocks. The likes of GM and Ford are under pressure. GM down 2%, Ford down 1.4% in terms of the pre-market. Some other flow for you is in the bond market as well. We have a little bit of an unseating of the Besant bounce yesterday, so we're seeing yields ride ever so slightly. Some breaking news coming through for you from Intel. This is on securing additional funding of $7.9 billion in U.S. chip subsidy for advanced factories. Now, of course, we've got the story today that Qualcomm is going cold on the idea of perhaps taking out Intel in a deal. That was a much talked about and speculated possibility. But this morning, the breaking news is that Intel secures additional $7.9 billion funding for U.S. chip plant construction. Okay, we'll keep an eye on that as we go through the morning. Well, as I said, President-elect Donald Trump, he has brought tariffs back to the fore for the first time since he won the election. Trump took to his website, Truth Social, yesterday to vow on imposing tariffs on Canada and Mexico and raising them on China. Here to tell us what those levies might mean for global trade, it is our trade czar, Brendan Murray. Brendan, it's interesting. This is about political promises made on the campaign. That's the narrative for these tariffs rather than deficits in the first salvo.
Yeah, exactly. So this was a stark reminder that the president, the incoming president, will use the threat of tariffs for just about anything he wants to accomplish on the international stage. In this case, he's pointing the 10% tariffs of China, the 25% at Mexico and Canada, because he wants them to crack down on the drug shipment problem and the immigration issue. So these are obviously key campaign issues that he wants to make a loud statement about. They're just threats at this stage. stage, but he has made no bones about the fact that he has the authority come January 20th when he's sworn in to put tariffs on unilaterally without any approval from Congress or anybody else on even our biggest trade partners, those three countries.
Look, I think it's one of those situations where it's sort of like shoot first, deliver on the political messages, but it got Justin Trudeau on the telephone. It got responses immediately from the senior leadership within the Canadian government, because their trade relationship with the United States of America is quite literally gargantuan relative to their European and indeed global peers.
Oh, absolutely. That is one of the main goals of threats like these is to spur conversations, negotiations, and to strike a little bit of fear in the opposition. You can imagine in Brussels today, they're going, okay, what does Trump have on us that we're going to have to, and how are we going to respond when he posts something on social media about the European Union? So the impact of this goes well beyond North America and China. Countries around the world that have imbalances with the U.S., which have industries that they're protecting against the U.S., are going to take notice.
And the response mechanism, I mean, there's a much more formal response mechanism from Canada. As I say, Justin Trudeau, the Prime Minister there, on a call, we understand, with President-elect Trump. China playing this free trade narrative that they do like to fly from time to time. But what has their response been so far?
Well, we just got a statement from the Chinese government, so we'll have to parse that a bit before we know. But generally, the Chinese response is very cautious, very slow, and very deliberative. So we wouldn't expect them to come back immediately with specific tariff level threats, but they would take a more measured approach. Perhaps get President-elect Trump on the phone and talk through about what exactly he meant and how they can address some of the concerns he has without sparking an all-out trade war between the world's two largest economies.
Brendan, thank you very much. Great recap. Brendan Murray there on the headlines overnight on trade and tariffs. Joining me now is Maria Waitman, Senior Multi-Asset Strategist over at State Street. Maria, it is deja vu. You can see the stoicism, really, of the U.S. equity market relative to the nervousness in Europe. So we're going to go into this particularly volatile period of time. How do you prepare for this? You're seeing the first narrative of tariffs too.
Good morning, everyone. I think it's really interesting that, I mean, what your correspondent just said, I think that kind of fits with kind of our interpretation as well, is that, I mean, so far, tariffs are a tool, a negotiating tool to get other countries to do what Donald Trump wants them to do. And, I mean, the first one was on kind of drug trade, really important for his voters. And the reaction, market is, like, not terribly concerned about it yet. I mean, it seemed to be like, okay, we are in this negotiation, quid pro quo kind of thing. Interestingly, reaction of U.S. stocks. U.S. stocks don't seem to worry too much, and particularly my favorite, like technology stocks. And Nasdaq futures are higher than like small caps and broader indices. So that's encouraging. So market is saying, okay, we are negotiating. See what kind of president-elect can get out of other countries.
And this goes back to, we had this Besant bounce yesterday, really both in terms of the dollar, in terms of the rates market, etc. But let's just hone in on your favorite. Your barbell is cash and big tech. I know that. We know that well. When you see Tim Cook in China for the third time this year, and he talks about the supply chain, and he says, I value them highly. We could not do without them. I mean, he's on the wrong side of the narrative here for the ensuing tariff war. But who has the strongest moat in regards to tariff in big tech, in your opinion?
I think that's a really important point. And like the big story about tech was moats around their business, who can compete, and it's very difficult. I mean, barriers to entry are enormous. And I guess if we are specifically worried about tariffs, production, quid pro quo, I think things like semiconductors probably stand potentially kind of attractive. Nobody wants to see like shortage of chips. I mean, we saw that during COVID. That was not pretty for anyone. I mean, software and another area where kind of potentially maybe there is like some softness and maybe less risk. So maybe hardware a little bit could be caught in a kind of a pawn in this tariff trade war game. But arguably, again, those businesses are extremely important for United States. They're very important for China, other Asian producers. So I personally struggle to see that being like on a really kind of damaged by that rhetoric.
Okay, so that sort of creates pockets and pools of opportunity for you. Every note that we've had in our inbox is talking about 6,600, 6,500, 6,600, maybe even by the middle of next year. Euphoria in credit. Are you in a euphoric state of bullishness?
I wouldn't probably go to the euphoric state of bullishness. Like you mentioned, like my barbell is tech and cash. So I am worried about kind of weaker points and cracks in kind of U.S. economy, global economy, kind of manufacturing side, smaller companies. I'm very skeptical about small cap trade. So those areas that are still challenging. We have monetary policy is still tight, and kind of rate cutting expectations have been scaled down quite a lot. So those areas that are struggling with kind of economic slowdown, they're in trouble. I just love tech, and that should support kind of overall equity market. But I very much doubt that the rally can broaden very much from what we've had this year.
So you doubt then the veracity of the rally in the Russell 2000. It's up 6 days in a row. It's put on 6%. It's been tempered a little bit. So you're still not tempted to diversify away from mega tech?
No, not at all. And actually, I would probably fade small cap trade. To me, that's potentially risky. I see kind of euphoric, I see kind of very optimistic sentiment that, okay, we are doing this America first rhetoric and we're going to support American business. That is great, but it needs to happen. I think what we're seeing right now, and that's the chart I keep showing my clients, is that proportion of small cap companies that are loss making are very close to recessionary levels. We're close to a quarter of the small cap companies.
So perhaps this is maybe this is a misfounded or misplaced exuberance in small caps. Let's just square off with the Fed. Obviously, one camper talking about the plausibility of a pause and building that narrative. I listened to Neil Kashkari. It's still a reasonable consideration. He's talking about a December rate cut. How important is it, Maria, that we see these yields are capped out and these rate cuts keep coming? Maybe not at the same pace, so shallower and less, but that they do continue.
Yeah, no, I think this is really important, and that's kind of the threats I'm kind of very concerned, the cracks in kind of under the surface. So, like as I said, small cap companies, a lower income consumer, more like manufacturing centric production. That's where the challenges are. And those are not huge part of the US economy, so they're not really kind of coming up in aggregates very much, but the pressure is there, and kind of if we start kind of having this narrative that we're not having cuts and we need to worry about maybe even higher interest rate, that would be a real problem. And I suspect those problematic areas will kind of grow and spread, and that creates problems.
Maria, thank you very much for being with us this morning. First reaction to the prospect of renewed tariffs around the world. Maria Waitman there of State Street. Are the stories trending on your Bloomberg terminal? This is what I've got for you this morning. Ken Leach, the former co-CIO of Western Asset Management, was charged by the DOJ and the SEC with running a cherry-picking scheme where he inappropriately favored some clients' accounts over others when allocating trades. Now, Leach's attorney disputed the government's case, saying it was unfounded and that his client acted properly at all times and would defend himself vigorously. Rivian received preliminary approval for $6.6 billion of a federal loan to support construction of its plant in Georgia. Now, the plans are to build the plant were halted earlier this year in a decision aimed at cutting costs. But the company still needs to meet certain conditions to finalize the loan. Walmart is cutting its DEI program, saying it no longer considers race and gender to boost diversity when granting supplier contracts, and will stop collecting demographic data when assessing financing eligibility. It is the most prominent company so far to pull back from diversity promises. Coming up in the show, Intel secures that $7.9 billion US chips award. We'll dig into the narrative, and Aaron Cannon joins me from Clear Harbor Asset Management to talk about the year-end play in markets right here on Bloomberg. Good morning.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell.
earnings from Caesars crossing the Bloomberg terminal.
Mondelez is reporting Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate, when your comps get tougher, how much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
Intel has secured $7.9 billion in the U.S. CHIPS Award for advanced factories from the Biden administration. Tom McKenzie is with me now. So, Tom, $7.9 billion, it's a little bit less than we thought that they were gonna go for. And in the words of Gina Raimondo, American-designed chips being manufactured and packaged by American workers in the United States of America. So this is a pretty important announcement for them, given the Qualcomm story. We'll come to that in a moment.
Yeah, absolutely. Look, and the way you phrase it and the comments from Gina Raimondo, really the focus on that American-made technology, which was the heart of the CHIPS Act, of course, that program of incentives and grants that was pushed through by the Biden administration. And to your point, the original number that we know Intel have been looking at was around $8.5 billion. The line's crossing the last few minutes, suggesting they're going to get $7.9 billion. That's been confirmed, $7.9 billion in terms of grants. It would still be the largest single grant from that CHIPS Act, of course, by the Biden administration. That was a combination of grants and loans. $7.9 billion will be going to Intel, and as you rightly say, that is contingent on it following through, meeting certain targets in terms of the build-out of its factories and foundries in states like New Mexico, like Arizona, like Oregon, over a certain time frame. They are likely to receive the first $1 billion as soon as this year, we are told. Intel saying that in the long term, they plan to invest potentially around $100 billion in terms of building out its manufacturing capacity in the US over the long term. So there's been some wrangling over this in the last few months. They've got it over the line now. Positive going forward for Intel in terms of being able to build out those factories at a time, of course, when it faces multiple challenges, as we saw from the most recent earnings report and the job cuts that have to come through. They've had to convince Washington. They have to convince investors now.
It's going to be interesting to see how this evolves in the next Trump administration, because, of course, the accusations from President-elect about Taiwan, stealing the chips business. So you know, a lot of stimulus has been delivered. But let's talk a little bit about Qualcomm, because we've learned, Bloomberg, it's a scoop for us, is that Qualcomm is losing interest in the potential takeover deal for Intel. Here's what the CEOs had to say on a possible deal earlier to Bloomberg.
Obviously, there's been rumors and churn in the industry, and I think all of that just indicates how important Intel is to the into the industry structure and semiconductors, and how important those supply chains are.
Right now, at this point, we have not identified any large acquisition that is necessary for us to execute on this $22 billion. And we're super focused on executing on that $22 billion in the next 5 years.
So, Tom, it looks like, Qualcomm has gone cold, but I love the line in the story, which is it could rekindle its interest a little bit later and come back for pieces. Of course, this is going to be so important in terms of what kind of regulatory regime we get under Trump 2.
Absolutely. And look, it could come back in a different form, as you say. It could come back if the environment, particularly around the regulatory framework, as you point to, changes, becomes more favorable, because that was one of the key sticking points. So going back to September, we know from our own reporting that they put out feelers, Qualcomm, around a prelim takeover of Intel. That was back in September after that terrible earnings report from Intel and the announcement of those job cuts and those weak forecasts. What we understand now is that on a number of fronts, 3 main fronts in terms of financial, operations, and regulatory, those are the key headwinds. They would face an antitrust process, not just in the US, but also in their key market of China, where both Qualcomm and Intel have a lot of market share at stake. But also in terms of operations, Qualcomm doesn't operate its own foundry. So the chip making, the semiconductor making parts of the Intel business, that would be in a whole new endeavor. And then on the financial front, $50 billion of debt that Intel has that Qualcomm would have had to take on as a result of this potential deal. So you're right. They've called on it for now, according to reporting. They could come back for different pieces of the Intel pie. Maybe if the regulatory winds change, maybe they come back to looking at it in its totality. But those are the 3 key reasons why they have called, Qualcomm have called on this potential takeover.
But of course, President-elect Donald Trump has promised a regulatory onslaught on independent agencies like the FTC. Not quite sure what that means, but we will begin to understand that a little bit more clearly in 2025. Tom, thank you very much. Tom McKenzie there. Great reporting on Intel. What might these tariffs that are being speculated, an additional 10% on China, 25% on all products from Mexico and Canada mean? Well, think about the autos who are producing and passing product through from various parts of the world back here to the United States of America. GM down 2.3%. Ground zero for the reaction function this morning is the foreign exchange market and the auto industry. Good morning from New York.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's your Bloomberg Brief. I'm Manus Cranny here in New York. Front pages look a little bit like this. Headlines from around the world. Kicking it off with the New York Times. Special counsel Jack Smith asked two separate courts to drop the cases against President-elect Trump. Within hours, one of the cases was dismissed. Smith said that the move was a necessity because of the DOJ's policy that it is unconstitutional to prosecute sitting presidents. Next up, the Financial Times says Citigroup is reducing the number of year-end promotions. Managers have been told that as many as 2,000 Citi employees will get a bump in their pay and their title. Citi said it made group-wide promotions and other role changes earlier this year. And the Associated Press leads with Formula One, saying that it will add GM's Cadillac brand to the American team in 2026. It will be called Cadillac F1. And it'll be run by the new Andretti Global majority owners Dan Tauris and Mark Walter. The team will use Ferrari engines for the first 2 years until GM and Cadillac engine get into the cars. So that's a little bit of news for you on the old F1 front. And actually, Walters is the CEO of Guggenheim Partners. He's got controlling interest in the World Series champion LA Dodgers and Premier League, of course, at home, Chelsea. I'll leave you with a snapshot of what the salvo from Donald Trump last night has been in regards to tariffs on the Canadian dollar and on the peso. That's where you're seeing the most reaction function, where the dollar is up, the peso is down by 1 1/8%. We'll give you context on Brief in just a moment.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Manish Craney. Let's set that agenda. It's deja vu. President-elect Trump vows sweeping tariffs to hit Canada, Mexico, and China with additional levies. The dollar strengthens, stock futures drop. Losing interest for now, Qualcomm cools on a potential takeover of Intel. More on the Bloomberg scoop coming up. And Minneapolis Fed President Neil Kashkari says it's reasonable to weigh another rate cut for December. The latest Fed minutes and consumer confidence on deck today. Ground zero for reaction to the prospect of tariffs on Canada, Mexico, and China as these currencies are ground zero for the reaction. Now, look, the Canadian dollar made it to a 4-year low, but nowhere near as brutal a sell-off as we saw in the very first reaction to Trump's election, President-elect Trump's election. The peso back towards 2022 lows. Just bear in mind, overnight on election night, that crashed by 3.5%. The dollar was up by 3.5% at one juncture. In terms of the other narrative out there, just roll it over and have a look at stocks. Minimal reaction in the United States. We're just dipping ever so slightly into the red. It is in Europe where there's perhaps a much more egregious reaction. They're waiting to hear what might be coming down the pike for them. I want to bring you a little bit of breaking news now. This is from the Biden administration proposing the following, that Medicare and Medicaid coverage obesity drugs. Just think of the names that this is going to impact. Lilly and Novo Nordisk would benefit as the supply shortages ease. The proposed rules, I suppose, a challenge for the incoming administration. So this is about access. You can think in terms of the numbers, nearly 7.4 million. How does that break down? 3.4 million older Americans on Medicare. You've got 4 million on Medicaid. So this is, I know that the Congressional Budget Office did some analysis that would possibly cost $35 billion over 9 years. Eli Lilly up 2% in the first sweep on this. So a significant announcement from the Biden administration proposing Medicare and Medicaid coverage of obesity drugs. Well, President-elect Donald Trump had been quiet on his self-professed favorite word, tariffs, until yesterday. For the first time since he won the election, Trump took to his website, Truth Social, to vow imposing tariffs on Canada and Mexico and raising them on China. Let's dig into this. Context Matters. We have our senior editor for tech and strategic industries, Mike Shepard from Washington. Mike, in the very first reaction to this, one can see that these are politically driven tariffs rather than the fiscal narrative that suited and shrouded the first Trump administration. This is politics, not deficits.
Yes, that's right. I'm glad you brought that up, Manis, because we are seeing a distinction with how Trump is intending to use tariffs this time around in his administration. He wasn't kidding when he said he really sees tariffs as his favorite word or his preferred policy tool. You'll remember back to that interview he did with Joe Rogan before the election when asked about the semiconductor investments in the U.S. that the Biden administration has been pursuing. He said, well, you could achieve the same results with tariffs, ignoring, of course, altogether the complexities in the semiconductor supply chain. But again, with respect to immigration, with respect to the desire to curb the flow of fentanyl into the U.S., he is seeing tariffs as a vehicle to pressuring U.S. trading partners, Mexico's largest U.S. trading partner, Canada number 2, China number 3, to get them to enact measures that would address these problems that he identified and that his voters had identified as well during the campaign.
And I think that's the essence of this. This is about illegal immigration. This is about fentanyl. This is about the supply chain of fentanyl, and very much laying down a marker of this is what I promised on the campaign trail, and this is what I'm going to deliver on day one. It evoked immediate responses, didn't it, Shep? You've got the Canadian government. You've got various senior voices there talking about what they've done and their trade relationships, and it got Justin Trudeau on the phone immediately, didn't it?
It did. It was within minutes or hours after the Truth Social post and the headlines hit that Justin Trudeau got on the phone with the president-elect. He wanted to make sure that Trump knew that along the northern border, there is a minuscule amount of illegal migration into the U.S. when compared to the southern U.S. border with Mexico. And he also wanted to stress that, look, Canadian law enforcement has been cooperating with its U.S. counterparts on the question of illegal drugs specifically. So they will continue this conversation. Justin Trudeau has dealt with Donald Trump before. We have not heard from the Mexican government yet. New President Claudia Sheinbaum is probably assessing right now how to come out tomorrow, especially since Mexico has been such a favorite target of Trump during his 4 years in office, in his run-up during his first campaign, and of course during the most recent campaign. China, for its part, warned that there is a risk in any kind of trade war economically. And they also made the point that, look, we're not going to discuss this right now. And in a sense, that acknowledges that from Trump at this moment, he's not even inaugurated yet. This is not a fully formed policy, and he would need to actually take some steps even to enact it on the first day. So there may be some room for negotiation and discussion too, as Justin Trudeau tried to open last night.
Okay, Shep, thank you very much. Great context there. That is Mike Shepard there. A little bit of breaking news for you now on Axios. This is what they're reporting, that Trump is mulling naming an AI czar in the White House. As I say, it's according to Axios. The czar would coordinate federal policy and government use of AI. Why does it matter? Well, you just think about Elon Musk. He won't be the AI czar, but he's expected to certainly get involved immediately in shaping that AI policy. He has been there pretty permanently since the start of President-elect's new tenure, seeing people come in and go out. A lot of people talking about perhaps conflicts of interest there, but that's a little bit of breaking news from Axios. My guest this morning is Aaron Cannon, CEO and co-founder of Clear Harbor Asset Management. Where to start? Good morning. Good to see you, Aaron. So here we are. We now have some understanding of the political motivations for these tariffs on Canada, Mexico, and China. This is just the initial salvo of disruption to come, isn't it?
Well, it very well may be, but it shouldn't be a huge surprise to Michael's, your previous guest's point. Trump has used tariffs before. We anticipate that he will use them again, and he said he would, and so he's doing that. But I do think it's important and to think that this is just politics, because there is a policy prerogative here. He did campaign on reducing the illegal trafficking of drugs, and particularly fentanyl, which is killing tens of thousands of young Americans and adults in the country, and the origin of which is China. And so the largest tariff that he announced was China, and of course the northern and southern border is where these drugs do flow, and particularly our southern border. And so this isn't a surprise in some important sense.
Well, look, the very immediate reaction function is in the foreign exchange market. Do you still believe in the power of Scott Bessent to be the adult in the room?
I think so. You know, he supports deregulation and the concept of fiscal discipline, bringing our deficits to GDP down from, call it 8% annualized over the last couple of years, which is totally unsustainable, to at least 3% by 2028. That's part of sort of the initiative that he believes in. I think this sort of feeds into the narrative that is probably somewhat accurate. Just we're going to see deregulation going forward in the Trump administration. And with deregulation, we're probably going to see a rise in mergers and acquisition activity across multiple sectors of the economy, man. It's particularly those that are probably not or haven't been the beneficiaries of this upward rise in the stock market, which has been heavily driven by mega cap tech. And so we could see financials, asset managers really serve as beneficiaries to this deregulatory trend that Scott Bessent embraces, and Trump certainly embraced on the campaign trail. It could also impact other sectors like industrials and even healthcare. And those are, you know, when you take a look at the top three sectors in the Russell 2000 index, for example, those are the top three sectors. And those are not the sectors that have driven the market higher over the last couple of years.
It's interesting. We've got this breaking news this morning on the healthcare stocks from the Biden administration, perhaps empowering Medicare and Medicaid patients for obesity drugs. I mean, this is what you would expect in the closing period of an administration trying to execute policy which can have a material impact. The drug stocks are rallying this morning. As you look into 2025, how do you look at that sector?
Yeah, it's sort of interesting. I think clearly healthcare is made up of, so many different components, the hardware side and in the biotech side. I mean, we talk about artificial intelligence, and clearly it's having a nice, we think it'll have a nice tailwind to the ability for research and development to accelerate so that drugs that are in sort of phase 1 and 2 can move through that process and become more commercialized more quickly. And so we think that, that's certainly going to be a trend going forward, regardless of who's in the White House. And frankly, artificial intelligence is playing an important role beyond healthcare and things like utilities and the demand for electricity. And also we're seeing, data companies that we always thought as sort of like asset management companies, like, for example, BlackRock, is becoming a massive data aggregator. And so the world's changing, and we're analyzing those shifts as we move into 2025 , Manus.
Do you have animal spirits? Do you have unbounded optimism? Do you where are you in terms of the scale of exuberance?
Well, I think our optimism comes from the reality that ingenuity is the driver of so much economic opportunity and social mobility around the world, and particularly has been on full display here in the United States. And so when we think about constructing portfolios for clients, Manus, we still think the equity asset class will continue to perform very well, public equities and private equities. In fact, if you look at the public equity market, since the 1990s, the number of public equities has collapsed. It's gone from like 8,000 to call it 4,000. We think there may be a little bit of a renaissance in the public equity market as private companies in this deregulated environment over the next couple of years maybe decide to actually enter the public domain again. And so, we think that there's a lot of opportunity under the proverbial mega cap tech hood within the overall market. Multiples, when you look at the multiples outside of mega cap tech in the United States, they're trading at like 17 times instead of mega cap trading at 30 times. And so we still think there's a lot of opportunity there across sectors, not only sectors that are like high growth, technology and consumer discretionary, but also, again, industrials, financial, asset managers, parts of the utility complex, materials, and even some of the energy areas, and not just traditional energy, which Trump has embraced, but we think some of the sustainability names will continue to sputter until there's clarity, but that ultimately there will be a demand tailwind for some of those key areas of the economy.
Aaron, I'd like to round off with, yesterday was very much about the Scott Bessent boom. The bond market yields dropped aggressively. There was a reaction in the dollar and quasi in equities. But when we talk about a fiscal hawk who wants to get a deficit to 3%, co-joined with Doge, how attainable, how deliverable is that 3% deficit by 2028? Because some people would say, well, look, you chose to have deficits at 6.5% during COVID. So how deliverable is that deficit hawk narrative?
Well, it's sort of a dilemma when you think about it for the administration, because if Doge is successful and they're able to cut, as Musk mentioned, $2 trillion a year from the budget, if you sort of look back at the last 3-4 years coming out of the start of COVID and the massive deficit spending, the Inflation Reduction Act, the so-called Inflation Reduction Act, and the CHIPS Act, that was about $1 trillion of spending. Some economists would argue that a third of our GDP growth over this period has come from unsustainable government spending.
Yeah.
And so could it be possible that we have a successful Doge implementation that actually dampens our growth prospects going forward. I think in the long term, we need sustainability, and so this is important because we can't run 8% fiscal deficits as far as the eye can see. That's
certainly not in perpetuity. Those bond vigilantes may well indeed make hay in 2025 if we continue on that road. Aaron, thank you very much. Aaron Kennan there of Clear Harbor Asset Management, reacting to the breaking news on Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
About artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Your Bloomberg Brief. I'm Manus Cranny in New York. Good morning to you. The headlines that dropped on the terminal a little bit earlier. The Biden administration is proposing Medicare and Medicaid coverage for obesity drugs. Novo Nordisk and Eli Lilly jumping on the back of the news. Our Bloomberg Intelligence senior pharmaceutical analyst Sam Fazeli joins me now. Sam, this is one heck of a bill that they're going to leave the Trump administration, $35 billion over 9 years. Let's break this down first of all. This is expanding GLPs pretty much for everybody who wants to get their hands on them. Supply side, first of all, Eli Lilly and Novo Nordisk, they are the producers of these. Have they got the capacity to meet this kind of a promise?
Yeah, so Manus, good morning to you. What we see here is not an enormous increase in the potential target market, if you think about it. 35 billion, we estimate that's about 25% of the population that could benefit from an obesity drug, so 25%. That's not an enormous lift. And remember, this 35 billion is over 9 years, so it probably means a lower amount to start off with, and therefore it ramping up. I'm pretty sure they can catch up with the manufacturing as time goes on. And also you could do the maths, man, as 35, let's say, evenly divided by 9 billion. What does that mean for the revenue? What's important to bear in mind is that RFK Jr. has been very clear about his views on the healthy eating, the type of food people have access to. he's against fast food and additives, etc. But in the meantime, I think he said that people should lose weight with healthy diets. Now, there's been plenty of studies that have shown that's just not good enough. Remember that a lot of these
proposed, and it's certainly not even as much proposed, and it's certainly not even as much as was on the table for them. Why the restraint?
Well, one part of it is that Intel will not be taking loans that were offered to them. They'll take the grant at a lower level, not the $8.5 billion that had been flagged earlier in the year, but 7.9 billion, and they're not going to be taking the additional loans that had been offered to them. We don't know why they're not taking the loans. The reason they're taking 7.9 billion or being allocated 7.9 billion instead of 8.5 is apparently because they received an additional $3 billion from the Pentagon earlier this year. So they've had a bit of extra juice pumped into the system as a result of that. In terms of the grant coming through, look, the CHIPS Act, 110 billion in terms of grants and loans in total, so this is the biggest allocation. It's going to help them build out their factories, particularly in Arizona, New Mexico, and Oregon. They're going to receive probably the first 1 billion this year because they've already achieved some of the targets that are set for them. And as those targets are achieved across the next few years, they will receive more of this allocated funding, 7.9 billion. Ultimately, Intel says they're going to be spending and investing about $100 billion to build out foundries, manufacturing plants for semiconductors in the US in the longer term.
So talk to me about Qualcomm. Obviously, Intel and Qualcomm, you know, we've had this story running for a while. This is a Bloomberg scoop. It is that Qualcomm going cold on Intel for now.
Yeah, for three key reasons. One is financial. Intel has about $50 billion worth of debt, which Qualcomm would have to take on if they took over the company in its totality. The other, importantly, is the regulatory environment, particularly the expected antitrust review and in the market of China. They'd have to have an antitrust review in China as well, key markets for both Intel and Qualcomm. And then the operational piece as well, that would also be very complicated for Qualcomm if they were to go ahead with this takeover, which is running Intel's foundries, the manufacturing piece of the business for those semiconductors, not something that Qualcomm does now, so they have to relearn that. That's why, according to reporting, they're going cold on this potential deal, but importantly, say they could come back for pieces of Intel at a later stage, or maybe even revisit it. But for now, they are cooling on this prospect.
Tom, great reporting. Tom McKenzie there on the latest on tech, right here from New York. Good morning.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves world's earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
To me, the most beautiful word in the dictionary is tariff, and it's my favorite word. It needs a public relations firm to help it, but to me, it's the most beautiful word. We're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before, and we're going to protect them when they come in because we're not going to have somebody undercut them.
President-elect Donald Trump there speaking to Bloomberg before the election about his favorite word dominating the news flow today. It is the word tariff. Ground zeros in the FX market. Is it a negotiating tool, or will he actually implement that size and scale on day one? Here's what you need to know for the rest of your trading day. Economic data, new home sales, consumer confidence at 10 a.m. Plus then we get the Fed minutes at 2 p.m. People will parse those for anything that shifts towards the possibility of a pause. Of course, Kashkari intimating otherwise. Dell and HP, those earnings come out after the market close. So we'll run you through those tomorrow. Here's how the markets are moving in reaction to that word tariff. The potential risk from President-elect, talking about Canada, talking about China and Mexico. It is the autos that you're seeing perhaps some of the biggest impact, and you just think of the kind of imports like Ford. They bring in the Ford Fiesta, the Ford Fusion, etc. from Mexico. The surveillance team will pick up the risk in just a moment.
To succeed in Wall Street, what skills do you need? You need to be somebody that claws people on the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency. The other penny was lower G&A, blah, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
As we look into 2025, you've obviously now shifted from election uncertainty to policy uncertainty.
There are real risks right now. There are real concerns in the market that we haven't seen in past years.
Markets are likely going to be volatile over the coming year, but probably still upward.
Market's gotten ahead of itself a little bit. There's still this very bifurcated political environment. It still feels unstable.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now on a 6-day winning streak on the S&P 500. Equity futures a little bit snoozy. We're pretty much unchanged and dead flat on both the S&P 500 and on the NASDAQ. The trade war commences right now, and this is how it's playing out. Not in equities, not in bonds, but in foreign exchange. A weaker Canadian dollar, a weaker Mexican peso, as President-elect Donald Trump comes out on Truth Social overnight and pledges to levy an additional 10% tariff on China and 25% tariffs on products coming from Mexico and Canada.
Really focusing in on immigration controls as well as the drug trade as part of the reason why he wants to increase the tariffs 25% on Mexico and Canada. The key question is, are markets correct in taking this largely as the opening salvo to sort of gauge the waters, to see what kind of response there's going to be? That said, there already is a response from the Mexican government pushing back against a BYD factory in Mexico. So you have to wonder, is there some meat underneath the hood here?
Well, when it comes to the Chinese tariffs that he's proposing, he says on top of others, on top of the ones that he proposed and put into place in his first Trump administration and then Biden kept, or on top of the ones that he proposed on the campaign trail, which was 60%. Then when it comes to Canada and Mexico, does this mean he's willing to rip up the trade deal that he negotiated in the first iteration of Trump 1.0, the USMCA? And not just Mexico that had an immediate response. Justin Trudeau got on the phone with President-elect Trump almost immediately. So his truths are actually working.
The negotiations start right now for Mexico, for Canada, for China.
So to me, this is a teaspoon of sugar helps the medicine goes down. I kept singing that this morning because I was thinking to myself, Scott Bessent, it's going to be business as usual on Wall Street. People got the sense that things were just fine, and then trade is going to be an issue. We're going to increase the tariffs. We're going to go hard. And I wonder if this is the strategy going forward. Placate markets. See how much leverage Donald Trump has with markets to then go hard as a negotiating tool with some of the potential trade adversaries.
Possibly. I think we have an incomplete picture still of what this administration looks like. We're waiting for an NEC director. Still need to wait to see who's going to be the trade ambassador as well, who's going to run USTR. So I'd make that point up front. On Scott Bessent, I agree with everyone who's written we've got an adult in the room. I agree with everyone who's written down on paper and published notes over the last 24 hours that we're going to have someone that really understands markets. What I disagreed with over the last 24 hours is that somehow he's going to take the sting out of the tail of whatever's going to come from the White House. I don't see that at all. In fact, the message I take from last night is there is one commander-in-chief, and it's Donald Trump.
That's exactly the point here, is that basically you have markets that are quiescent because of the idea of an adult in the room, and Trump is going to take that opportunity to show who's boss. And so it raises this question of, will it be palatable to markets that right now aren't moving significantly? As you pointed out, you're not seeing some big sell-off in stocks or a big sell-off in bonds. It is the foreign exchange. It is the American exceptionalism story.
When you look at the Wall Street Journal editorial board on Scott Bessent, they were talking about the fact that he had this conversion over the campaign trail from blanket tariffs, or really from him wanting to be a negotiating tool, this idea of warming up to blanket tariffs. This goes back to this idea of President-elect Trump is going to have almost an angel and a devil on his shoulder. We know who the angel might be, that individual that pushes back on policies like blanket tariffs, Scott Bessent at the Treasury Department. But who is going to be at USTR? It's a great question, Jonathan. And some of my reporting is that even Peter Navarro, was in the works potentially to be the NEC director. Maybe he doesn't get that job, but he's definitely a part of conversations.
Equities right now are doing okay on the S&P 500. We're just about unchanged. Coming up this hour, we'll catch up with Steve Chevron of Federated Hermes on why he still likes equities. Dan Clifton of Strategas as President Trump promises new tariffs. And Stephen Cook of CFR as Israel and Hezbollah inch closer to a ceasefire deal. We begin this hour with the stock rally stalling after President-elect Donald Trump vowed to impose additional tariffs on China, Mexico, and Canada. Steve Chevron of Federated writing, we view tariffs, or more importantly, the threat of tariffs, as a way to encourage reshoring instead of nearshoring. If this works, this means more FDI, capital deepening, and growth. Either way, we like stocks here. Good morning, Steve Chevron. It's good to see you.
Good morning. That was topical, huh?
What did you make of that move overnight?
I think the fact that he did it this early, he's getting exactly the response that he wanted. He got the call from Trudeau. He's getting the reaction out of Mexico. And again, to the point of what we wrote, the Trump administration views the 70s through 90s as this period where advances in global communications, supply chain management led to kind of manufacturing moving overseas. And it gutted the industrial Midwest. They view AI, robotics, automation as an opportunity for those jobs to come back because you need less labor to produce. But the problem that they see is that it's more likely for those jobs to nearshore, go to Mexico. And so tariffs, more importantly the threat, is designed to say, look, if you're going to leave China, go to Alabama. Otherwise, we're going to make your car so expensive if you build it in Mexico that it's untenable. Again, if that works, and you do get investment back onshore in the United States, that's not inflationary, that's pro-growth, it is capital deepening, and it can rebuild communities that have been ravaged for the last 30 years. If it doesn't, it's inflationary.
Do you think the primary channel for this to play out in financial markets will be through one particular asset class, and that's foreign exchange? Or do you expect to see this to show up in equities?
I think you used a word at the open, snoozy. I think the reason why the reaction from stock and bond markets are snoozy is we've seen this game before. We understand how it plays this time. There's a strong statement at the beginning with a very difficult negotiating position. The negotiations are tough, but ultimately reasonable, and you get to a place that's acceptable. I'd point out that for all the optimism yesterday about Besant, the equity market rallied in advance of the election on the economic policies proposed by Donald Trump, not Scott Bessent. So I think the market understands that tariffs are going to be part of this agenda, and I think they've digested that already. So as long as there's not something that's, shocking outside of what's been proposed, and, nothing so far has been, I think the markets know how to digest it this time.
That said, are there certain industries that are just uninvestable in a tariff war? Where basically you're looking at the auto manufacturers, for example, and you don't really understand what the dynamic is going to be. You look at other manufacturing sectors that are truly in flux and that have been and are dealing with the potential of regulations that are changing as well as potentially tariffs. Does that make you stay away from some places?
It's not industries so much, right? Because for any industry, you're going to have a domestic producer that benefits just as, maybe a foreign producer doesn't. I think, and we think, that the big loser here is Europe. I mean, I think that if you look globally, that's the big loser, right? Even in EM or China, you've got a stimulus bazooka that is starting to be fired. I think those concerns are well understood. But if you look at Europe, you've got a scenario where the German economic engine is broken, right? There's no more cheap energy from Russia. There's no more endless demand from China. You probably don't have a free U.S. security guarantee anymore. You've got political gridlock in both the UK and France, so having a kind of coordinated response is going to be difficult. And I think if anybody's going to get wrapped up in the tariffs here, it's going to be Europe. So is it uninvestable? No, I don't subscribe to that word. Whenever I hear uninvestable, my instincts are, well, let me find something to buy there. But do we want to be overweight Europe? No. No, and we reduced that about 2 or 3 weeks before the election, expecting that would be the big loser.
Your call is 7,000 by the end of next year. You're in tandem with Binky Chadha over at Deutsche Bank in terms of a pretty high bar for how much U.S. equities can rally. Is that truly going to be a unique lone spot of gains in a sea of red for the rest of the world, accentuated by Europe, or will it percolate out to the rest of the world?
I think it's going to be strongest in the United States. I mean, I don't know that it's a green spot in a sea of red. But if you look at the fundamental, forget about the politics for a second. You've got earnings that are still growing high single digits, expected to accelerate. You've got a Fed, and I think we've seen some Fed speak over the last couple of days, that still appears committed to getting to neutral. Whether or not that's 3% or 3.5% over the next 18 months, it's certainly lower than where rates are today. You've got tax cuts coming. And even though tariffs are a tax, when you take them in the context of tax cuts, it's a net tax cut. You've got deregulation likely coming. My goodness, if we got anywhere close to a 3% fiscal deficit, I mean, that's just pie in the sky. The fundamentals are still solid. The jobs market is still solid. And I think, look, it's most acute in the United States, but the U.S. is the consumer of the world. So they're going to be beneficiaries outside the U.S. from a strong U.S. economy. So no, we don't think it's green in a sea of red, but we think it's the greenest dot.
When you look at Europe, though, today equities are under pressure there, especially the auto industry. You say you don't like anyone saying something is uninvestable. Yep. Maybe you'd want to get exposed. Would you ever get exposed to European autos going into a Trump 2.0 administration?
I mean, I think what you would look for if you wanted to get excited is who's going to be willing to put their assembly plant in Alabama. I mean, I think that's the answer to this. It is a tariff unless, right? It's a tariff unless you stop having drugs come across the border. It's a tariff unless you assemble in the United States. So there's a path forward if they want it.
Do you see the sequencing then of Trump to be tariffs and tax cuts, meaning the stick is going to the tariffs, the carrot is going to be 15% potentially corporate tax rate if you build in the USA?
I think he kind of has to because, again, I think the game here is to rebuild the industrial manufacturing base, this manufacturing renaissance. The issue is that everybody knows he's a negotiator. So in order for the threat to have teeth, you got to shoot a couple pigeons and hang them from the roof. So I think you will see some tariffs that are actually implemented to make companies understand that these are the rules of the game. And in order to blunt that, right, in order to blunt that, I think you will see broad-based tax cuts. And that's why I think some concerns over inflation are overdone, right? If you just look at the tax cut piece, it's inflationary. But if you then offset that with some tariffs, well, that blunts that, right? If you're reducing government employment, that also is disinflationary. So you've got to look at the policies all together and understand, you know, it's chaos, but there's a strategic chaos here.
This got violent quickly, didn't it? Pigeons on roofs.
Well, who's the pigeon? Is it Canada, Mexico? Who's the pigeon?
We don't know that yet. I think that's the question. What are the industries or the companies, right? It looks like maybe it's autos. It looks like maybe it's Mexico. But clearly what you're going to see, I think, first is I'm going to follow through on some of this. And then that's going to be the impetus for other people not to try.
Just before we let you go, lessons from 2024. I was looking back to last year and looking out 12 months, and the average outlook was 4,800 on the S&P 500. The most bullish on the street was 52. That was John Stolfus of Oppenheimer. We're north of 6,000.
Yeah.
What didn't we anticipate in 2024? What might we be getting wrong about 2025?
You know, we go through self-reviews each year, and I just wrote mine, and you know, lessons from 24 was the first one. And I think the first one is that investing is both an art and a science, right? You can do the work on the earnings. You can understand what an average multiple might be. And that's really where we all start. But then you have to anticipate, well, what's not captured in that? Understand you can have a false sense of precision. What might the market discount going forward? Where might optimism be? What relationship has changed, right? Should you have a 20 times multiple on a market when 30% of that market cap is Mag 7? And I think that's the story. You have to remember there's an art, and you get back to the 7,000 number. Science doesn't get you to 7,000 next year, right? What you have to assume is that there's some pull forward of good expectations as you buy the rumor of policy, and maybe you sell the news a little bit after it happens. And so I think it's the art part of this business that's the lesson.
You've got to buy some hopes and dreams. Steve, it's good to see you. Have a happy Thanksgiving. Thank you, sir. Steve Chevron there of Federated. Equities right now on the S&P just about positive, up by almost 0.1%. With an update on stories elsewhere this morning, here is your Bloomberg Brief. Tesla would be shut out from consumer rebates under a proposal by California Governor Gavin Newsom. Newsom planning to offer rebates to EV buyers if President-elect Donald Trump repeals a federal subsidy. More on that story a little bit later. Elsewhere, Qualcomm's takeover interest in Intel is fading. Sources telling us here at Bloomberg the complexities associated with acquiring Intel have made it less attractive to Qualcomm. A deal would likely have been one of the largest ever in tech. And finally, President Biden proposing a rule that would require Medicare and Medicaid to offer coverage of weight loss drugs, including Ozempic and Wegovy. The proposal could slash out-of-pocket costs by as much as 95%.
This is really interesting because guess what? President Biden is a lame duck president. So what he's basically setting up for is a proposal that will or will not the incoming Trump administration actually want to take on board.
It's over to you, Donald Trump. Up next on the program, the tariff man is back.
To me, the most beautiful word in the dictionary is tariff, and it's my favorite word. We're going to have thousands of companies coming into this country. We're going to protect those companies with strong tariffs because I'm a believer in tariffs.
The negotiations start right now, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
So all is quiet in equity land, at least stateside. Equity futures on the S&P 500 firmer by 0.1%. Big rally in the bond market yesterday. This morning, yields are higher by a single basis point, the 10-year 4.28. And what you see across foreign exchange is just a much stronger dollar, particularly against the Canadian currency and the Mexican peso as well. Under surveillance this morning, the tariff man is back.
To me, the most beautiful word in the dictionary is tariff, and it's my favorite word. We're going to have thousands of companies coming into this country. We're going to protect those companies with strong tariffs because I'm a believer in tariffs. I brought in with tariffs 2,000% tariff, the highest tariff in history. We're going to put tariffs on them, the tariffs. I put tariffs on China. I put tariffs on South Korea, the threat of tariffs. You're going to pay 100% tariff.
So here's the latest tariff, a new front in Donald Trump's trade war. The president-elect Donald Trump writing on Truth Social he would impose 25% tariffs on all products from Mexico and Canada and an additional 10% tariff on all goods from China, indicating they are needed to combat the flow of drugs and influx of migrants across America's borders. Dan Clifton of Strategas joins us now for more. Dan, welcome back, sir. It's been way too long, buddy. Let's go straight into this. Perfect timing. Your reaction to this overnight. What are you telling clients?
Yeah, so I break those tariffs up into 2. China, very likely to happen, very little pushback from Congress. That process was already established in 2018, 2019. Those tariffs are very likely. Companies with exposure to China are going to take a hit from this, and we expect the supply chains to migrate out faster. India will likely be a beneficiary. Mexico and Canada is a little bit more complex because you're already bounded by the USMCA agreement overall. And I think what Trump's trying to do is get ahead of this big caravan that's starting to come into the U.S. and basically saying that we need you to lock down on immigration. He does not want to surge at the border before he comes into office. He also does not want to have to deal with a lot of issues as he begins to shut down the border on his first day of office, and he's trying to get ahead of that. So my sense is that's a little bit more complicated. It's more of a negotiation strategy, but it's one that's very significant because investors have been very focused on Europe. They have not been as focused in timing on Mexico. And then two other key points that I would make. If I was Donald Trump, I'd be looping in Congress right now. What we found is that Canada and Mexico are very good at coming up with retaliation strategies. So if I have Congress on board, it makes it harder for them to target specific congressional areas. And then second is personnel as policy. Without Robert Lighthizer, you really don't have that key personnel to be able to move these tariffs pretty quickly. They're going to have to figure out how they're going to get that structure in place because there is a bit of a learning curve for Howard Lutnick and for Scott Bessent on these. And then final point is that why we had that big rally yesterday, Scott Bessent's an excellent Treasury Secretary pick. As you get into the specifics and the details, this will be done through an interagency committee, and obviously Treasury will have a very big impact on that. And that's where I think some investors think that these ideas can wind up getting watered down a bit from the initial conception stage that we saw last night.
Dan, when it comes to Canada and Mexico, did this Truth Social post actually work? Because we had Justin Trudeau make a phone call last night almost immediately wanting to start that negotiating process.
This process has been going on for weeks. If you look at Canada, they've been talking about just blocking Mexico out, knowing that Mexico's direct investment, China's direct investment into Mexico was becoming a liability for this administration. So they were ahead of it. They were planning for it. You also see Mexico starting to say, hey, how about none of this Chinese investment, particularly from the EV companies? So you're already seeing that posturing. And I think that's the whole point of this, is that there's going to be changes if it changes from the U.S. side, if there's not changes from the Mexico-Canada side, and you're already seeing it. But it is a bit more complicated than that. Like if you look at Europe, they're like, hey, well, we'll buy more liquefied natural gas export. They're not saying, hey, we're going to put American cars in Berlin. That's what Trump ultimately wants. So Trump's going to need to see real results rather than just this initial posturing that you saw yesterday. But I actually think it's an encouraging sign. I think that's why the market response is a bit more muted this morning.
If you have an executive order for these kind of tariffs, that basically means that would override USMCA. So Correct. If he does do this in January, where does that leave USMCA?
So like I said, I think it's complicated on the Mexico-Canada side because of USMCA, and there will be lawsuits and the force of law is in place. We also think that there's some legal issues around a universal tariff due to the International Economic Emergency Power Act. And so that's why he wants Congress to institute tariffs as part of the tax bill. It gets you revenue for the tax bill, and it makes it legal to be able to do this. So some of this is posturing itself, but I'm not really sure that he can move quickly on Mexico and Canada tariffs the same way we know he can move quickly on those China tariffs, and why we've been advising our clients that the China stuff is real, and it's not about a negotiation. He sees them as a true national security threat, and he wants American companies out of there. So the difference in the intensity around the tariffs is that China's a lot more real than Mexico and Canada because of the constraints that you're listing, particularly around the USMCA.
Dan, a note from Deutsche Bank's George Saravelos just popped into my inbox, and he had this point that I thought was really salient, that the softer the market reaction, the greater the likelihood of more tariffs. The first Trump administration showed that the more benign the market reaction, the greater the likelihood of further escalation. Do you think that that is right? The fact that markets have been so tempered means that we're likely to hear maybe a little bit of a ratcheting up in some of these threats.
I think those are great points, and I think that the threats will ratchet up, but I also would say that we're not playing with live ammunition yet, right? Right now, Joe Biden is president of the United States. Donald Trump has not come into office. He doesn't even have his full trade and economic policy team in place. These start becoming a lot more real on January 20th, right about noontime. So I would be careful not to interpret the reaction as a little bit tempered. And I would just say yesterday is a very significant day for us because the Monday before Thanksgiving in 2016, a media report came out that the border adjustable tax could be included in tax reform. That was the first day where you saw the honeymoon of the post-Trump victory start to go away. And I just found it to be ironic last night that we were at the Monday before Thanksgiving talking about the same type of issues overall, and it hovered over the market for months, and it became a lot more real once January 20th comes. So I think, you know, if we're still having this conversation on February 1st, I think that point is really salient. It is still salient right now, but let's see what happens once he gets into office.
Dan, let's build on that, the timing of this, the fact that he is issuing these threats on Truth Social about certain tariff limits, and that this is happening before he truly takes office as he names his cabinet picks. What's your interpretation of the timing?
I think, well, one, I think that he sees caravans coming through Mexico and he wants to stop those caravans. So this is more of an immigration ploy. It's almost like these tariffs could be stopped if you fix the immigration system. But the second is, it's showing you exactly that this president knows what he wants to do. What I've been advising my clients throughout the Treasury Secretary debate is that Donald Trump got 75 million votes, Scott Bessent got 0, right? So Trump is telling you he's going to do tariffs, and it's telling you that his internal staff are the ones who are driving policy. Those are going to be Stephen Miller and some other folks. And as the cabinet gets there, they're going to shape what the details are. They're going to move the process forward on how to implement it. But Trump is very clear about what he wants to do, and investors need to take that seriously. And he's moving forward, even without his full staff in place. I think that's a really important takeaway from the events over the last couple of days.
Dan, always great to catch up with you, buddy. Dan Clifton there
Great.
at
Thank you
Strategics
for
on the
having me.
latest. Good to see you, sir. I think we've learned a lot over the last few days, what the real objectives are. Ultimately, the border, immigration, narcotics, the tool to deal with it, once again, tariffs, opening up the negotiations ahead of January 20th.
Do you take him seriously or do you take him literally? And maybe the answer is yes. And maybe markets aren't doing enough of that. And that's sort of a question of how do you interpret this ahead of his even taking office at a time where headline risk is very real.
Something Bank of America said yesterday morning, that investors are underestimating trade war risks under a Donald Trump presidency. And EMFX specifically is underestimating trade war risks and looking for a 5% slide in emerging market currencies, including, of course, China's currency.
You asked a great question. Is this going to be isolated to the currency market, or does it have broader effects across asset classes? And I think the answer is we don't know yet, because we don't know what the application is going to be of these tariffs.
This is just the beginning in a long journey. You're going to hear a lot about this for several years. Equity futures right now on the S&P, up by close to 0.1%. Up next, we'll catch up with Stephen Cook of CFR on a potential ceasefire deal between Israel and Hezbollah.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Into Tuesday, 6-day winning streak on the S&P 500, the longest since September. S&P 500 equity futures right now just about unchanged. On the Nasdaq 100, we're dead flat as well. Bit of weakness on the Russell, the small caps down by 0.4%. In the bond market, yesterday a much better tone. Big rally, yields lower, some clarity on who's going to lead the Treasury. Ceasefire deal proposals over in the Middle East, dragging crude down, contributing to this move as well to some extent. Yields up a single basis point today, 428.48. Just looking at those two asset classes, you wouldn't have a clue what was taking place elsewhere. Switch at the board and get to foreign exchange. Here's the story. Let's turn the page to FX. Dollar strength. Mighty dollar strength against the Canadian dollar and the Mexican peso. Dollar Mex, Lisa, advancing by 1.2%.
This is going to be basically the playbook by which a lot of people are going to be looking to trade some of the headlines that we're going to be getting on trade. Basically, the announcement on Truth Social, which is the pathway for announcements, we should say, for President-elect Donald Trump these days, talking about a 10% additional tariff on Chinese goods and 25% blanket tariffs on Canada and Mexico, really affecting the FX channel as sort of the opening salvos. Is this negotiation or is this a taste of what's to come?
The dollar index pushing 107, 8 consecutive weeks of dollar strength, and this could be week 9 if it continues. Under surveillance this morning, President-elect Donald Trump vowing to impose additional 10% tariffs on goods from China and 25% tariffs on all products from Mexico and Canada, casting the move as necessary to clamp down on migrants and illegal drugs flowing across America's borders.
Two things come to mind. One, he wants to move quickly. He's still in Palm Beach and Mar-a-Lago. He is not in the White House. We are in a lame duck Biden presidency. But already you see movement. Justin Trudeau picking up the phone and wanting to start that negotiation because he's saying there's going to be an executive order when he comes in. Is that the opening salvo, or potentially is that going to be a real executive order at the end of January? Second, it comes after he put his Treasury Secretary in place. He loved, obviously, the market move yesterday. You saw that across a number of Trump Twitter posts and those next to him talking about how this Bessent rally was up. So he had a moment in time to show, yes, everyone's talking about how Scott Bessent is pragmatic when it comes to tariffs, but Jonathan, to your point earlier, I'm the man that's going to be in charge.
I woke up this morning thinking I need to learn MAGA better. I need to speak the Trump language a little bit better because there is this lack of clarity about whether it is, okay, the markets were up, okay, now we can hit them with this, or if it's more of a matter of I need to take the reins back and then necessarily show it's my agenda and this is what I'm going to do.
I think Trump would call this either, coordinated chaos or the weave. You can move from one thing to another when things are slowly moving in place. The market is up, so maybe I can go hit them with this. We have to wait and see.
I think he's been pretty consistent on this point. I don't think there's a weave here. I don't think there's a back and forth. I don't think we're playing multi-dimensional chess. I think we've heard this repeated on the campaign trail. In the last few weeks when we were selecting a Treasury Secretary, reports suggested this was the clear goal, to have someone that would agree with his views on tariffs. I think the president-elect has been very consistent on this theme. He's brought up Mexico a million times, as have we over the past few months, about what we'd see in the coming years.
The real question to me is how much the market actually acts on as a check. right? How much is he sensitive to not unraveling some of the gains that has already been experienced in equity markets? And then I think it's still a question mark. Is this the way he's going to do it, to offer up something that's going to calm the markets while still going hard in the policies that he has already stated he is ready to go on?
Possibly. We saw that a few times in the first term. At the moment, though, President Biden is still the president. I think we've all forgotten that, but he is still the president. And this could all change again on January 20th.
Yeah, he tried to remind us of that earlier this morning.
A few times.
Yeah, a few times. Like, hey, guys, hi, I'm still here. Just letting you know.
We'll get to the latest on that front later. I wanted to get to this, an important story for Tesla. California Governor Gavin Newsom unveiling plans to offer rebates to EV buyers if Trump repeals a federal subsidy. Newsom's office telling Bloomberg the proposal would exclude Tesla's popular EV models. There has been tons of pushback against this proposal, including from the Democratic congressman in California disagreeing with his own governor.
Yeah, Ro Khanna, he's coming out and he's saying how many Teslas are made in his district, more than 500,000, employing more than 20,000 people. And this is the quote: "Let's not play politics with keeping manufacturing in California. It would be foolish to exclude Tesla. Have we learned nothing from snubbing Elon Musk at the Biden EV summit?" I was at that summit. Joe Biden loved it. He got into all these EVs. GM took it for a spin around the South Lawn. Tesla was notably missing. And Ro Khanna's point is, why are we going to snub this individual once again?
Well, it comes at a time when a lot of people are saying that a lot of policies are going to become increasingly transactional. And I keep wondering about that. It's easier to be transactional when you're in the White House. And I think that that's one clear message. In the meantime, this does feel like a high school spat on Snap, where Newsom and Musk are kind of going at each other because they've had a long-standing tiff.
But also, if you're for the Inflation Reduction Act and Trump comes in and repeals it, and you're trying to just mimic that within your home state, well, guess what? Tesla is allowed to, customers are allowed to buy Teslas with that subsidy. So why would you exclude them now?
It makes absolutely no sense. Economically speaking, it makes absolutely no sense. You are producing Teslas in California. I don't see a big presence from GM, Stellantis, and Ford over on the West Coast. I see them up in Detroit, Michigan. It's just bizarre that they're still doing this. And to Ro Khanna's point, to the congressman from California, it appears that they have truly learned nothing.
Well, it becomes very personal. And you start to wonder, again, how much can people take the upper hand by trying to strip out some of their personal vendettas? Because we know that Newsom and Musk have a long-standing personal vendetta, and that seemed to be coming out in some of these policies.
Apparently that vendetta continues. Let's turn to the Federal Reserve. Benny mentioned them. Investors digesting Fed speak ahead of the latest FOMC minutes due at 2 p.m. Eastern, a little bit later this afternoon. We've heard from Neil Kashkari saying it's still appropriate to consider a December rate cut. Goolsbee making the case for easing, barring signs of overheating. I'm thinking back to the news conference with Chairman Powell, where he basically said to the news conference and market participants watching and listening that there was nothing to model yet on the tariff front. Do we have something to model now?
I don't know.
Donald Trump.
I'm not sure. I mean, can you model it basically from the Truth Socials? It'll be interesting to see how they message that. In the meantime, the fact that both Goolsbee and Kashkari came out and said it's appropriate to cut rates, with Goolsbee taking it a step further and saying that the neutral rate was going to be 2.9%, and that he leaned into that median assessment of Fed officials, signals that maybe they're not going to come out with modeling. And when it comes to tariffs, there have been so many people around this table who have said that they are disinflationary or deflationary over the longer term that it becomes very difficult to even know how to begin to model these from an economic perspective, let alone a policy one.
Do you expect to see some Fed chair auditions over the next 12 months? Who can outdove each other?
I'm curious if we're going to get one before that. And is it going to be outdoving? What is exactly it going to be? Or just sort of taking the temperature? I mean, if Kevin Warsh is the likely successor, well, he hasn't exactly been a raging dove.
No, in fact, I would say a raging hawk for the last decade plus.
So is that the sort of qualification that makes it okay? I think it becomes really muddy. I think it starts to become heads.
That name is always circulating. Ideologically, just incompatible with what you hear from Donald Trump, president-elect, on the campaign trail repeatedly.
Pretty much.
Doesn't stack up.
Absolutely. And we have to remember that Jerome Powell was put in place by Donald Trump. So we're talking about this. So sometimes people can become less appealing to the president-elect post facto.
Before we get to the Federal Reserve meeting on December 18th, I'll keep going through the calendar for you. December 6th, payrolls. December 11th, CPI. Let's turn to the latest in the Middle East. Israel and Hezbollah inching closer to a ceasefire agreement. Israel's Security Cabinet meeting today and may vote on the deal. Stephen Cook of CFR writing, like everything since the conflict began in the region back in October 2023, leaks and reports of progress should be handled with great care. Prime Minister Netanyahu is motivated to get a deal deal because he wants to deliver for President-elect Donald Trump. Stephen joins us now for more. Stephen, welcome to the program. As you've suggested, we've seen plenty of head fakes over the last several months on this front. Does this feel different?
Well, it does feel different. I think the reports coming out of Israel, Lebanon, and Washington are more detailed than the kind of imminent ceasefire deals that we've heard about for the last 6 months with regarding Gaza. At the same time, there is actually a fair amount of opposition to a ceasefire with Hezbollah. The mayors of the northern communities of Israel are in a rage, believing that this ceasefire will leave them vulnerable once again to attacks from Hezbollah and even October 7th style attacks. Those towns have taken a beating from Hezbollah rocket fire and anti-tank missiles over the course of the last year. And the folks who live there just don't believe that the IDF has done enough in order to push Hezbollah back to make those communities safe.
There's reports that Netanyahu has basically approved this plan in principle, but what does it take for the entire cabinet to get on board?
Yeah, and that's the rub. The Security Cabinet is going to be meeting in just about 4 hours from now. And there are members of the Security Cabinet who are raising questions about it, notably the Agriculture Minister, who used to be the director of Israel's internal security services, the Shin Bet, who has said and vowed to the mayors and residents of northern communities that he will not vote for this agreement if it's just a cut and paste job from UN Security Council Resolution 1701 dating back to 2006, which was never fulfilled. And was really just an agreement on paper. The Israelis are looking for, at least the opponents of the agreement as it currently stands, are looking for actual action, not just a piece of paper that commits Hezbollah to staying far away from Israel so it can't attack it.
Do you think the deal does enough to ensure Israelis can return to their homes?
Well, once again, the deal calls for the deployment of the Lebanese army up to the Israeli border. It ensures that Hezbollah has to stay north of the Litani River, which is about 18 miles north of the border. There is a committee led by the United States that will monitor violations. But all of this depends on the goodwill of the parties. You can imagine a situation in which the Israelis cite a violation and want to retaliate, yet the United States doesn't agree with them, creating tremendous amount of tension between Washington and Jerusalem. So this is a complicated deal, but as I said, Netanyahu is motivated to get this done because he wants to deliver something to President-elect Trump before inauguration, and he just politically can't bring the Gaza conflict to an end by the time the president-elect takes the oath of office.
Stephen, how much is there a bigger takeaway? The people are exhausted with these wars, and I'm talking about what's going on with Israel and in Gaza and with Hezbollah into the north, as well as what we're seeing over in Ukraine, that with more than 800 deaths of Israeli soldiers in Ukraine, thousands, hundreds of thousands of people having been killed, there is a real question here about whether the populations will even tolerate an ongoing conflict.
Yeah, that's the case. I mean, we see it in Ukraine. Over 1,000 days of war, people are growing quite tired of it, and the idea of a ceasefire in place is growing there. In Israel, this is a doctrine-busting conflict. The Israelis never contemplated fighting a war on multiple fronts for over a year. Their doctrine is to fight short, devastating conflicts on enemy territories that don't last much longer than 3 weeks. And there is a revolving door reserve duty in which only about 70% of the population takes part. The others are exempt. So there is a real burden on the population, on the kids and reservists who are as old as in their 40s and 50s, who've been in and out of the Gaza Strip, in and out of southern Lebanon, and people are tired of it. So even if the northern communities in Israel are opposed to this deal, there are many in Israel who do want to bring at least the conflict in the north to an end, so long as it brings the rocket fire to an end. And that hasn't happened yet.
Stephen, what are you looking for to know that this is actually imminent?
Well, I'm actually looking for the cabinet to vote for it and there not be any delays or any postponements. And I'm also looking for it to be successful, for the Lebanese army to actually deploy and for the Israelis to be satisfied that they can retaliate should Hezbollah violate the ceasefire, which is only supposed to last about 60 days.
Hey, Stephen. We all hope for peace, and we hope we get a deal sometime soon. Stephen Cook there of CFR, thank you, sir. Certainly the commodity market took it seriously yesterday. I think crude was down by about 3% across the board.
Yeah, that's sort of what I'm pointing to, is that the markets are taking this seriously. Again, is this a time to be trading the headlines and fading every single one that comes out because every single time there's a head fake and something that goes wrong? Or is there something that we can look for that could potentially signal that it's real?
Well, there's a lot of momentum going into this deal. Amos Hochstein spent all of last week there. But what's interesting is Stephen Cook's talking about the fact that Israelis want to get this done now. The impetus is there to deliver a win for President-elect Trump, potentially one thing off his agenda as he enters office.
It's like Trump's second term's already started, and we're still in November.
Well, it's sort of maybe
Well, it has.
intentionally done that way, and I wonder what signal we'll get to where we'll be on February 1st.
Biden's got other thoughts based on some of the policy pushes that we've seen over the past few days.
Honestly, I just wonder how much he's trying to basically take some of the sales, the wind out of the sails. Basically, you want efficiency? All right, try to take this little bit of candy away from the population.
If you are just joining us, welcome to the program. Equity futures right now in the S&P just about positive by 1/10 of 1%. With an update on stories elsewhere this morning, here is your Bloomberg brief. The DOJ and Google making closing arguments in a federal antitrust case. The Justice Department accusing the company of monopolizing the online ad market. Google claiming its dominance is due to a superior product. A judge's decision is expected by the end of the year. Elsewhere, President-elect Donald Trump is considering appointing an AI czar. Axios reporting the person would be responsible for coordinating federal policy and government use of the technology. Trump advisor Elon Musk reportedly won't take the role, but is expected to be involved in discussions on AI use cases. And finally, Starbucks saying its software supplier has been hacked, forcing the coffee giant to manually log employee pay and hours. The supplier, Blue Yonder Group, saying its systems were disrupted last week in a ransomware incident. Now that's a mess before the holidays.
Yeah, that is a mess. And also, wow, that's so much time and labor you have to use someone instead of, baristaing.
Baristering. Okay. Up next on the program, we'll leave that there. Inflation set to squeeze holiday shoppers.
In this environment where CPI, inflation across all these different products, it's eating away at that wallet, the consumer's really looking for somebody who's going to provide them the ability to stretch their dollar.
Is that even a word? I'm not sure that's even a word. Up next on the program, that conversation continues live from New York City. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
Equity futures right now pushing higher by 0.2%. We'll round it up for you. In the bond market, yields higher by a single basis point. After dropping by double digits in yesterday's session, the 10-year back to 428.48. Under surveillance this morning, inflation set to squeeze holiday shoppers.
We like to separate value versus cheap. So value is price paid for quality received. If you look at the retailers that are sort of winning in this environment, they truly are kind of giving back real value to the consumer. CPI, inflation across all these different products is eating away at that wallet. The consumer's really looking for somebody who's going to provide them the ability to stretch their dollar.
So here's the latest this morning. Holiday shopping is expected to break records this year, signaling just how much higher prices are impacting consumer spending. Nita Richardson of ADP Research Institute writing, higher prices could dim holiday cheer. For a long time, wage growth for hourly employees was outpaced by inflation. Nita joins us now for more. Nita, always great to see you. Welcome back.
Thank you.
What's the outlook for spending this holiday shopping season?
Well, the outlook for spending is at record highs. The National Retail Federation expects consumers to spend $900 per person per family this year. That's up like $15 from last year. So strong spending this year is expected. But the problem is we're on a knife's edge when it comes to wage growth versus inflation. In fact, we only expect for hourly wages, hourly workers, which are about 60% of the labor market, we only expect their wages to tread just above CPI inflation. So that's like 30 basis points. So as prices are going higher, wages aren't keeping up.
How big is the spread between how consumers say they feel versus how much they do? Because how they feel has been pretty awful for quite a while now. But then I look at retail sales, and retail sales are still really robust. What do you think explains that?
Labor markets. Because even though wages are just keeping up with inflation right now, people are employed. If you look at layoffs, they're very, very low. There's not this threat, impending threat of doom when it comes to what's going to happen after the holidays. Will they still have their jobs? For many workers, they still feel confident about the labor market. What they lack confidence in is in prices. They keep going up higher, and they're already at high levels, and that's what's changing the game in terms of sentiment.
Has there been a behavioral shift where people are being paid, they are employed, and yet they're not levering up? That people still have the specter, whether it's the financial crisis, whether it's just simply this time of high inflation and feelings like you need to get your personal finances under control. You're not seeing credit card delinquencies pick up in a material way. Is there a message from that?
I think there is. First of all, consumers are being a little sharper about their finances, but we can't go too overboard in optimism with the low delinquencies relative to the past. We have to also look at savings rates, which are also low. So we're in this purgatory, if you will, in terms of consumer balance sheets. They're getting by, but they're living paycheck to paycheck. They're not putting away savings at the same rate that they used to. Credit card delinquencies aren't picking up yet. So yes, this is a happy period for the consumer, but it is, again, a sensitive period. You don't know what could sway the consumer into more debt and into less savings than they have been.
It's taken a long time for the average worker to catch up to inflation, and they feel like they've been left behind, and we've seen that increasingly. John was talking about the sentiment surveys. Have people caught up?
No,
what would
not
it
at all.
take? So
Not
what
at
would
all.
it take for them to catch up in a material way with wage gains that could put them at least on the same track they were, or relatively close as pre-pandemic?
Look, we look at data all the time at ADP. We're looking at hourly workers. I was just reviewing 14 million hourly workers and their average pay. For the better part of the last 4 years, the worker has been underwater, meaning their wage growth is not keeping up with the inflation that they're seeing in retail, in consumer price inflation. So we haven't kept up in general as a workforce. There is pockets of light now. We're finally starting to see a little bit of an increase in wage growth above CPI inflation, but it's tenuous, it's vulnerable, and anything could trigger a reversal in that wage growth versus CPI. So no, the worker is not keeping pace. Consumption is being led by wealthy, more affluent households, and the average worker is still trying to keep up. That's why you're seeing lower savings rates, yet not spilling over into delinquencies, and that's going to be the barometer to watch about the health of the consumer.
Yet they're spending more this holiday season. And December last year, inflation was north of 3%. The prior Christmas, it was north of 6%. Is there this idea that the consumer is also just getting more used to inflation?
Well, they are certainly spending like it. I mean, they don't like inflation. They may, rally against inflation when it comes to our sentiment surveys, but it hasn't dented the enthusiasm in spending. What consumers want now is cheaper prices, very quickly goods. We're used to real-time consumption, and they're getting that right now. After the holidays, it'll be a good benchmark for the real status of the consumer. People tend to go over their skis a little bit during the holidays. Will they pull back in January? Will companies pull back in January? That's what we'll be looking for.
You said that some of the gains are really fragile and that they could be derailed. What would derail them?
Well, higher prices. Higher prices. And if consumers or businesses who are betting on lower interest rates going into the new year don't get that bet realized, there's indications that inflation is sticky. It's not moving down in the straight line that was expected. If we see a stalling in the interest rates, if consumer credit becomes more expensive, if it costs more for consumers to borrow, to buy cars, which are also seeing some price growth, to fund purchases, then that could stall some of their spending behavior.
Do you think the Fed hits pause?
That's an open question. I mean, you're hearing a lot of Fed speak suggesting just that. There's been no Fed speaker that I've heard recently that has come out definitively and said inflation is going in the right track and we're confident enough that we will lower rates in December. There's still uncertainty around that decision.
It's going to be an interesting few weeks, that's for sure. Nina, it's good to see you. Nina Richardson there of ADP. Up next on the programme, we'll catch up with Stuart Kaiser of Citi. We'll speak to the Congressman French Hill. Matt Lassetti of Deutsche Bank thinks the Fed will hit pause, and they'll be on pause through the whole of 2025. We'll catch up with him in the second hour of Bloomberg Surveillance in just a moment, and we'll speak to Terry Wiseman of Macquarie as the negotiations on Trump's trade war commence very, very quickly overnight. Equity futures on the S&P, I have to tell you, this is not what I expected this morning. We're higher by 0.2% on the S&P 500. In the bond market, it is a snooze. Yields are up by a single basis point. The action is in foreign exchange, and that dollar is a whole lot stronger. From New York, this is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions? And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's